In those doubled steel and aluminium tariffs from Trump on Friday, and we watched Sanofi as well. Because it's an M&A Monday, we have Sanofi to buy Blueprint Medicines for $9 billion of equity value. So a lot to keep our eye on as we head towards the open, Critty.
It's a fascinating one as well, because a lot of those sectors might actually have ripple effects when it comes to the actual index story. So ArcelorMittal, how does that show up in perhaps the FTSE 100? Maybe that metals trade is the divergence we're seeing. Well, we don't have to guess anymore. Let me bring you the opening trade right off the bat. FTSE 100 virtually flat at this open. It doesn't tell you a whole lot about the excitement you're seeing in the FTSE 100, which is that where that divergence to me really stands out. You got the IBEX right out the gates as well, down about 0.3%, taking a minute for the stock 600, taking a minute for the CAC Iran. There it is on the stock 600, down about 0.2%. Not necessarily reflecting the same pain trade you perhaps saw in that futures picture. I was just pointing to a stock 600 with a 0.6% decline. We are not seeing that just yet. And the DAX right off the bat, there it is. There's that pain trade, which Lizzie tells me very quickly, there's risk sentiment across the board. The idea of that geopolitical risk, both emanating from the States and from Europe, is perhaps what's weighing on these markets across the board.
Yeah, so we've got pain across the red across the screen for European equities this morning. If you break it down by sector, all but 3 sectors are in negative territory as things stand. Tech is at the bottom of the basket, down 1.3%. Autos and parts not far behind it, down 1%. Consumer products and services just behind that as well. So that's your sectoral breakdown. We did mention that you could have a movement on ArcelorMittal shares. They're down more than 1%. As we say, reacting to that tariff news, Trump doubling the steel and aluminium tariffs, and ArcelorMittal, of course, a steel maker. And so that pain is already showing up. We talked about defense as well, and we are off to the races for Rheinmetall, up 2.3%, Saab up 1.4%, Leonardo up 1.5%, BAE Systems getting that extra boost, of course, from that UK defense spending, and that's up 1.6%. But a bit of weakness for Safran and Airbus, notably.
It's a fascinating one as well to see this divergence, and you mentioned the defense story, you mentioned the Rheinmetall as well as one example, but this from a sector perspective is a decidedly defensive day, and I'm curious whether that's simply waiting for the U.S. markets to open, waiting for a little bit of cautiousness there. The pharmaceutical sector right out of the gate, Novartis, for example, GSK, one of your biggest movers that you are seeing, gaining about 1.5%, GSK higher by 0.7%, and Novo, of course, so that's kind of the vol trade in pharma at the moment, so higher by 2.4% as I speak.
Yeah, and also I did say that we needed to keep an eye on Poland. The WIG 20 down 3.1% off the back of that election result, the Trump candidate winning in a real nail-biter of a race. Yeah. So Polish stocks, despite their rally so far this year, not happy this morning.
And we should just mention the fact that just because you mentioned the Polish piece of this equation, Poland is not an economy or stock market that we talk about very often on this show. But admittedly, but perhaps we should, because it is actually one of the best performing. And a lot of that is because of the migration story that's going in there. A lot of that is just this economic growth that is unmatched by others. Poland is one of the few countries in Europe that's actually meeting that 5% defense target.
Yeah, and we had a fantastic piece from our colleague Michael Masika about the outperformance of European stocks, but keep an eye on the periphery is what analysts were telling him. And I thought it was interesting that Ghanaian stocks were the top of that leaderboard. But let's discuss more. We've got Laura Cooper, Head of Macro Credit and Global Investment Strategist over at Nuveen, with us round the table. Good morning, Laura. Just take us through what you make of the moves that you're seeing in the markets this morning. I think we need to start with the defence story, because that's what we're really trying to make sense of. We've got underperformance for the DAX, but we have got outperformance for the likes of Rheinmetall. How do you factor in such massive news around what's happened in Ukraine and Moscow over the weekend?
Well, I think when it comes to European equities and what we're seeing in the German DAX, it's important to acknowledge the starting point. This is an equity market that has had remarkable gains year to date, really surpassing its peers. And I think there's a question around kind of that performance and as well valuations. I mean, the German DAX is trading at 15, 16 times price to earnings. So I think there was a little bit of nervousness that had gone too far. So I think the fact that we are seeing geopolitical tensions come through, yes, one would think that that should bolster those defense stocks, but we're coming from already a high starting point. I think over the medium term, this is certainly warranted, but in the near term, I think there's more caution still to play out.
And when you talk about Poland, as we admit we don't do very often, is it the periphery that you need to be keeping an eye on at the moment?
I think more broadly, it's about the risk premium that it needs to be baked in on the back of a number of uncertainties, whether that's coming through on unknown tariff news or whether it's geopolitics. The fact that we have seen European equities outperform the U.S. quite robustly year to date, I think there is a question of how much more can that reallocation away from U.S. assets persist. If we look at what happened more recently in earnings, the tech earnings in the U.S. were so pronounced, I think that does warrant a rethink of some of those large cap positions in the U.S., particularly in this environment where we are seeing volatility become more subdued.
I think one of the key questions as well, I mean, Lizzie approached it from a defense sector perspective and kind of where does that underlying investment strategy work, but just from a risk sentiment perspective. We've been talking for years about the fact that there is perhaps a little less of, I don't want to put complacency as the key word there, but complacency or a little bit of less of a factoring of the Ukrainian story into your broader investment thesis. Today seems to be a little bit different, and I'm curious what that red line is, given that in the last week or so, we've now seen Germany take a much heavier involvement, a much heavier say than the United States. Is that something the markets are missing?
I think it's very hard to price in geopolitical risks. Typically, when we do see a catalyst like a significant event, we have a knee-jerk reaction in markets, but it does tend to fade. I think the key question is how does one position in a potential multipolar world where we don't necessarily have that one global powerhouse going forward? And I think markets are still recalibrating to what that potential new regime looks like. I think the way we're positioning it is still looking at this is a backdrop where markets are increasingly discounting the tariff news. You know, there is still that tariff risk premium that needs to come through. And I think we're more focused on the extent of economic damage that is potentially going to come through in U.S. data, most particularly because of the uncertainty around a number of these factors, geopolitics and trade, but as well just how much we're going to see cracks in the labor market. I think that's a key focus for investors, certainly this week.
I was about to say on Friday, it's a perfect preview on Monday, but give us that sentiment change, if you will. We've seen an uptick in initial jobless claims, for example, last week. Where's the red flag in this data?
Well, I think the conundrum has really been, we've seen the deterioration in soft data for quite some time. Okay, when is that hard data going to catch down? But now we're in an environment where that soft data is starting to stabilize. So if we do see, the dents come through in the labor market, maybe some of that stabilization in soft data will have investors believing that that economic damage will be fairly short-lived and fairly limited. So I think almost in a sense we're going to have a bit of a balance in terms of soft data catching up and that hard data catching down. So I think it is yet to come in terms of the payrolls, but we'll be watching certainly to see whether it falls off a cliff. That's not our expectation, but I think markets, are certainly waiting for that next catalyst.
The soft data is so funny because, and I say this almost comically because we're talking about things like TSA data, for example, or TSA pre-check data, airport travelers, foot traffic, and Starbucks, for example. So much of that is sentiment driven. So much of that is headline driven, that tariffs are going to bring up the cost of iPhones and therefore people are going to stop spending for a month. The Fed and other central banks love to say we're data dependent. They love to say one data point isn't enough. How many data points are enough to get a more pronounced monetary policy reaction in either direction?
Well, I think the key challenge is that we really saw that peak tariff backdrop was in early April. We don't have enough hard economic data given the short time frame. So we have to rely on some of those high frequency indicators, particularly around the consumer, given the consumer is such a prominent component of the U.S. economy. I think from a central bank perspective, we had Waller comments overnight that really did signal that, perhaps the inflationary backdrop will be fairly transitory because consumers aren't going to have higher nominal wages. They're not going to go out and spend, but they could curtail their discretionary spending. They could actually start to see those cracks in the labor market. So we'll be watching key indicators like vehicle sales. We'll be watching retail sales, because we think a lot of the boosts that we've seen to start the year maybe have been some front loading ahead of those tariffs. So I think we'll be watching some of those key indicators, but I think for the Fed, it's really all about the payrolls data coming through. We need to see it in the hard economic data.
What about the ECB? Because I think it's interesting that you only see one ECB cut nailed on for the rest of the year. Why is that when the market's so sure we're going to get two?
I think that view is largely predicated on the fact that the tail risk around a substantial trade war has essentially been reduced. We're seeing consumer sentiment gauges improve in Europe. We are seeing an uptake of credit, and that fiscal impulse, yes, we have yet to see it come through, but we still think that has to be a part of the ECB calculus. So we think the Governing Council is going to be comfortable getting to just the top of their neutral range at 2%. We remove that additional 25 basis point insurance cut. But again, to Kriti's point, this is all about data dependence. We think September maybe is a risk of another cut, but we're leaning against that. If anything, we could see some of that defense spending brought forward sooner, and I think that's a risk that markets are not yet positioned for.
But if we bring that back to the European equity story, right, you've got, as you say, this room for fiscal boost to growth. Others at least think that there's more room for the ECB to cut. Others say that, equity valuations aren't stretched. So why do you argue then that there's limited upside for European equities, or that the growth is set to slow?
I think the growth is set to slow just given the remarkable pace of gains that we've seen year to date led by Germany. And a lot of that is already baking in that fiscal stimulus sentiment. I think if we look at what the outperformers have been, we expect utilities, industrials, financials to continue to be the ballast of support in Europe. But it's more of those cyclicals that have struggled. We think those are going to continue to be challenged, whether that's, chemicals, consumer discretionary. I think it's really a bifurcated market. It's about the dispersion, and really one that warrants very selective approach within Europe.
So much of it, and you mentioned this kind of outperformance in Germany that's been driving the European market, at least in the first quarter. There has been a key question about the structural shift in portfolios, that you just want to deleverage from the United States, and that is the bulk of what these kind of repatriation flows have been, at least to Europe, and also American allocators to Europe as well. Is that over? Is that structural shift over?
I think it's a question of whether this was actually a structural shift or whether this was just a tactical reallocation on the back of relative attractive valuations, and as well as some of that growth catalyst that we did see coming through in Europe. I think U.S. equities, there's still a fundamental story at play, even if we do see this policy uncertainty extend. That's largely predicated on a lot of those tech stocks really being the engine of earnings growth. They had more than 30% earnings in the first quarter relative to the rest of the S&P 493 of only 8%. So there is still that robust earnings backdrop that we think can support U.S. equities. And I think as well, to your story, it was really more of an equity story. Have we seen that kind of foreign appetite dry up for U.S. Treasuries? Well, not necessarily. I think if anything, we're just seeing a repositioning across the curve in the U.S. We're preferring short duration exposures because more of the fiscal dynamics that are coming through in the U.S., but we're not necessarily seeing a flight away from Treasuries despite the uncertainty.
Do you think that's coming in July when we hit that debt ceiling and the deficit widens, or if this tax bill over in the States makes it through Congress? Do you think that kind of flight, I should say, from Treasuries is coming upon us?
I don't think that's necessarily the case because there really is no other alternative at this juncture if we think about this on a structural basis. I think what we are going to see, though, is we're already seeing in the bond market is further curve steepening. We're going to see investors demand that higher term premium. You have already seen it rise quite significantly, above 90 basis points, looking at that 10-year tenor. That lack of fiscal restraint that will require higher yields to maintain that demand base for U.S. Treasuries. So I think that's one of the ways that we're playing it, that curve steepening, and then looking at those short duration exposures, because it is much more anchored. And yes, there's risks around the Fed. We have the SEP coming up. If they say, well, maybe we only want one cut this year instead of two, that's going to have a risk. But I think really your risk reward is beneficial if you stay in that front end.
Fascinating stuff. Laura Cooper, head of macro credit, global investment strategist, Naveen, joining us this morning to talk to us a little bit about what that European trade looks like across the asset classes. We thank you so much. In the meantime, let's make a quick look at the core six. Come back to this equity market because a couple of different themes that we're keeping an eye on. Novo Nordisk is your sole outperformer out of the core six, higher by 1.4%. That is a pharmaceutical story. One from cancer drugs, kind of trial drugs over the weekend, getting a little bit of some positive news there, but also a little bit of perhaps of the Roche M&A Monday, Sanofi M&A Monday story as well. So the pharmaceutical sector seems to be, I think, leading the defensive charge this morning, at least to the upside. The rest are very much in the red. ASML, I think, is your heavyweight down there, about 1.5%, and one of your biggest contributors to the downside on the Stock 600. We're going to keep you apprised of these market moves. Stick with us. Coming up on the program, UK challenger bank Monzo reporting record profit. The group's CEO is going to be joining the program next. Stick with us. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the U.S. and China.
No one covers geopolitics like Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back to the opening trade. We are 17 minutes into today's session, and you can see the Stock 600 down 0.2%. Lots of geopolitical news to factor in this morning. Slight upside for stocks in London, and that's where we're going to go to next. UK challenger bank Monzo has reported 48% revenue growth and an 8-fold increase in profits for the year to the end of March. Monzo, which first returned profitable in June of last year, now boasts more than 12 million customers. So I'm pleased to say we are now joined by Monzo's Group CEO, T.S. Anil. T.S., good morning to you. Thank you so much for being with us this morning. I know that you've raised hundreds of millions of dollars last year to try and finally crack the US market. That's an area that we're looking at in these results this morning. How is that effort going?
Thanks for having me, Lizzie, and thanks for the highlighting the big results that we had last year. We raised capital to build out the Monzo business, both here in the UK and expand our international ambitions as well. And that capital has been deployed, as you can tell, in growing customers, more products, and in turn, more geographies as well. The US is a part of that strategy as we look to expanding globally and expand, making sure that every part of the world has the Monzo. In the US, we're still at the early stages of building the right product for customers, learning from customers, and iterating to make sure that we can build the best bank for the American customer. Internationally, we're also building our strategy in Europe, as we're public about, and we've got we're domiciled out of Ireland, and we're building out the European strategy as well.
And are you partnering with local banks on the ground, or are you considering outright buying a US bank to try and help with that expansion in the US?
So the US has a pretty well-established model of fintech players partnering with sponsor banks in the US, and that's exactly what we're doing as well. We're focused on making sure that what Monzo brings uniquely to the American customer is a product that brings all of your money needs in a single place and lets you meet your needs of budgeting and borrowing and spending and saving and insuring all in a single place, and doing that with delight and changing your relationship with money. To do all of those things, we partner with a local bank.
Well, talk to us about the bigger banks. In terms of expansion, Lizzie there was talking a little bit about partnering and your expansion efforts in the United States in terms of a listing, but talk to us about partnering with potentially a larger Wall Street bank at the same time that they're trying to do exactly what you just outlined.
It's pretty clear to us that other than the sponsor bank relationship that we will require in the US, here in the UK, as we've scaled our business, we're now 12 million customers in the UK. We're one of the largest banks in the UK, period. We don't need to partner with a local bank to do that. And the important thing over here is that the power of our product and this idea of bringing the best of technology and the best of banking together to transform people's relationship with money is the mission that we're embarked on. And it doesn't require, partnering with Wall Street banks or any of that to build that out. We've clearly shown that we can distribute and scale ourselves.
Tia, talk to us a little bit then about just kind of when it looks, in terms of the products that you're offering your customers. When I think of Monzo, I think of it more as kind of a debit account or a deposit account, but there is talks, at least, that Monzo's looking to expand into the credit and lending space as well. Your thoughts on the latest and the risks that might come attached with that?
Well, so in the UK, we help customers budget and borrow and spend and save and insure and invest. So it's across all of the financial needs of a customer. We're early in the US, if your question is specifically about the US product, where the US product is oriented first towards budgeting and transacting tools, and over time it will have everything else as well. But in the UK,
and there's been reporting recently, TS, about potential listing that you've been lining bankers up. Is that true?
It's too early to talk about it, Lizzie. What we're focused on is scaling our business, reaching more customers with more products. And, we will make a great public company one day. It's just too early to talk about it.
But when that day comes, are you considering London or New York? Do you have a preference?
It's too early to talk about it, Lizzie.
Well, you got to give her credit for trying, TS. You absolutely have to. And when you do make that decision, we look forward to having it right here on Bloomberg. But TS, walk us through what, perhaps, if you don't know where in New York or in London that listing may be, what the Labour government can perhaps do to make London a little bit more enticing. This is a conversation we have with your peers across the financial and tech sectors all the time.
Yeah, look, like other tech companies and private companies, we've worked with this government as well as with policymakers across the board to continue to make the UK, even more attractive. But it's way too early for us to really talk about specifics of what it will take, and when we get to making a decision.
But is the point that they're not hitting the mark for you yet because you're not even thinking about listing in London yet?
It's too early to talk about it, Lizzie, because what we're focused on is actually building the business and scaling it, improving, continue to reach more people, more customers, more products, as I said.
Tias, talk to us a little bit about the kind of consumer you're reaching. I'm really curious about this. When you talk about your next leg of demographics that might be interested in a Monzo account, for example, who are you targeting here when some of your rivals are really kind of targeting, I want to say, newbies to the labor market, the younger demographic? What does that do for you in terms of the competitive landscape?
Sure. So there's a couple of things over here. Like most digital adoption curves, your early customers tend to be more tech savvy and often younger customers. But what we're playing to be is a universal bank. Our mission is making money work for everyone. And that means meeting financial needs of everybody across the board in a single place. And so, we have hundreds of customers, even in the 90s, who bank with us. And, last I checked, 2 customers more than 100 years old who banked with Monzo as well, proving this idea that simplifying money and changing people's relationship with their money is a universal need across demographics. And we expect to meet everybody's needs. And in any sort of new adoption sort of context, in a new market with a new product, you sometimes see younger customers as the place it starts. But eventually, we want to meet everybody's needs.
Just coming back to the US market, TS, just a few years ago, you withdrew your US banking license from the OCC because of the engagement that you'd been having with regulators at the time. Now that President Trump is in office and pursuing this agenda of deregulation, I want to ask you if you think it would be easier to pursue a license yourself, what your early conversations have been like with the Trump administration and the regulators.
Yeah, like I said, in the US, what we're focused on is building the right product for the American customer and to meet their needs. And we know that in the US, having a banking license is not a must-have to be able to do that, given the sponsor bank model works incredibly well as well. So right now, we're focused on the product, Lizzie.
Monzo Group CEO T.S. Anand, we'll leave the conversation there. We look forward to having you back again when you decide where that listing is coming from and where you go forward with your business. We thank you so much for your time this morning. Thanks. Lizzie, I want to bring it right back to you here because, of course, we've been having this big conversation with T.S. there about where this UK environment is in terms of growing a business, in terms of investing, et cetera. Some news coming out over the weekend, I believe, when it comes to the non-dom status. Can you just walk us through it for our global audience?
Yeah, so wealthy non-doms exodus. This is a concern, of course, at the moment that because of the regime change under the Labour government, that actually more non-doms are going to leave than the Office for Budget Responsibility is estimating, and that's going to mean that it costs the UK Treasury more than it raises. And so this new report by Chris Walker, former member of the government's Economics Service, founder of the consultancy Chamberlain Walker Economics, sees that number topping 10% and more to come. And that's an interesting number to me because the Centre for Economic and Business Research says that if more than 1 in 4 non-doms leaves the UK, then you're going to hit that crunch point where actually it costs more than it raises. So it looks like we're heading towards that according to this new report, but not quite there.
What's the reaction function to that? I mean, if we hit that red line in the sand that you just outlined, what happens next?
Well, there is the argument that Labour could just bring the policy back with a completely different name. I remember speaking to a Conservative Chancellor before the election that brought Labour in, a former Conservative Chancellor saying it'll just be back with another form. But who knows what form that would take. It just comes down to whether the UK government is alive to this competition when you've got the likes of Monaco and Milan, the Middle East even, vying for these non-doms, these globally mobile, wealthy individuals to come to them and bring the investment and jobs that comes with that wealth.
Absolutely. That foreign and direct investment that we're seeing from abroad, this is the conversation we have in the States all the time, certainly in continental Europe as well. It's a crucial one we're going to continue to monitor as well. We also have one eye on the oil prices as well, because even though risk sentiment is a little sour across the board in the equity market, I'd even throw in the bond market as well, oil singing a different tune this morning. Brent crude trading at a 64 handle, NYMEX at 62. That geopolitical risk premium has narrowed. We're looking at about a less than $2 spread between the two. A lot of this has to do with the trade story. It's really mostly OPEC plus here. A hike over the weekend, but not as big of a hike as expected. We're going to talk about the next steps, especially in the context of what's going on in Ukraine and Russia. Stick with us. This is Bloomberg.
In case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%. And I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running at like 20, 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, you know, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance. Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is the opening trade. We're about 30 minutes into today's session, seeing risk sentiment sour across the board. And I think it's interesting, especially seeing it in the DAX and the CAC 40 as well. Now, this is crucial here because that underperformance that we're seeing in the context of the geopolitical tensions and certainly the latest attacks both in Kyiv and in Moscow, the DAX is one of your underperformers. The CAC 40 taking a bigger hit. Perhaps that's a trade story in the background as well, Lizzie.
Yeah, and if we look to the defence picture, so you've got outperformance for Rheinmetall at 1.9%, Saab up 2.2%, similar moves for Leonardo, but underperformance perhaps for BAE Systems. And this is interesting given that today is the day of the UK Strategic Defence Review, and there's still this question over whether the UK is spending enough on defence. We've been hearing from the UK Prime Minister Keir Starmer this morning declining to commit to that 3% defence goal until funding is clear. So basically, after Trump came in, of course, we had Starmer promising to raise defence spending to 2.5% of GDP by 2027. The US, of course, wants 5%. They floated this 3% target, but they're not guaranteeing that money at the moment because, of course, we know that the UK is so fiscally squeezed. He's also, the Defence Secretary admitted that he's still trying to stop a net fall in the size of the army. So when you look at BAE Systems, maybe this is a bit of nervousness about whether the money is going to come through to spend on UK defence stocks and whether actually all of that money is going to be going just to UK companies or to US companies as well.
Absolutely. I think Sharon Bell, among others, had said that some of the 70 or 80% of the European defence spending ultimately leaks back to the United States because of those key players. That's going to be something we watch, especially given the conflict and the latest headlines over the weekend. The conflict between Ukraine and Russia ratcheting up just as the two sides were set for a second round of talks in Turkey. And Ukrainian drones hit Russian airfields as far as eastern Siberia on Sunday, while Moscow launched one of its longest missile and drone attacks against Kyiv. And Ukraine's neighbor Poland as well at the same time has elected a Donald Trump-backed nationalist as its next president. These are all interrelated stories in three different geographies. Oliver Crook, our European correspondent, is all over. He joins us from the Polish capital in Warsaw. Ollie, before we dive into the Polish elections first, I know you've been covering the story out of Ukraine very, very closely. Just walk us through these rise in tensions and why these long-range attacks are such a big deal.
Yeah, and of course the attacks over the weekend will be closely followed by everybody in Poland who's been one of the staunchest sort of advocates and supporters of Ukraine. And seeing what we saw over the weekend, this sort of very sort of ingenious, spectacular sort of covert operation by the Ukrainians, taking out, if you believe President Zelensky, about a third of the Russian capacity in terms of cruise missile delivery across the country, all happening as you have simultaneously, allegedly, conversations happening in Turkey about getting towards a ceasefire. The second person-on-person contact from the delegations, from the Ukrainians and the Russians meeting in person again in Istanbul. Remember, the first time that we had those talks, they were at the behest of President Donald Trump, who was really trying to push both sides to the negotiating table. The only thing that was really worked out was a prisoner swap. We expect more discussions along those lines, more discussions about possible prisoner swaps between the Russians and the Ukrainians, but potentially getting still some distance away from the sort of holy grail here, which is a full unconditional ceasefire. The Russians have shown basically no inclination to move forward with that. They seem to be gaining initiative on the battlefield. And again, we should say that despite the fact that you have these conversations and that the Trump administration really is pushing the ceasefire, we are seeing from both sides, the Ukrainians, some of the boldest military action within Russian borders, and for the Russians on their part, some of the most intense bombings that we've seen over the last couple of weeks in Ukraine since the very beginning of the war. How do you interpret that? Could it be that everybody is trying to get into a better negotiating position and we may be closer to discussions on a ceasefire? Or is this just more evidence that this war is going to continue to be bloody and is anywhere near conclusion?
So, Ollie, factor in the story from where you are. You're in Warsaw covering the Polish election. It's been a loss for the pro-EU, pro-Kyiv candidate. Where does that leave the future of Ukraine? Where does it leave the story for the European Union?
Yeah, we should say that in Poland, unlike many of the other European countries where you have far-right, right-wing candidates, they are still very supportive, even the Law and Justice Party of Ukraine. They're very, very skeptical of the Russians. That is due in large part to the long history for Poland being attacked by the Russians and the Germans, and they're very sort of sensitive to anything like that. So you're not going to see anything like rapprochement to the Russian side. That being said, the president candidate that won, Karol Nawrocki, says that basically there is a red line. They do not want the Ukrainians to join NATO. That was one of the sort of great distinctions between these two candidates as far as Ukraine is concerned. And as far as the Europeans are concerned, they're currently embattled, yes, with supporting Ukraine against Russia, but they're basically now at trade war with the United States. What they would have liked to have seen in Brussels here in Poland is a candidate that shows more European solidarity, that does not undermine the position. And what you have today, very, very narrowly, is a candidate that is much more Eurosceptical, much more anti-EU, not advocating anything like the AfD, like withdrawing from the European Union, but basically wanting to take a lot more sovereignty from the Poles. That is not a strong negotiation position from the Europeans, who really would like to give a united front to the Trump administration, a Trump administration, we should say, who did back this right-wing candidate here in Poland, which again will help sort of undermine the European position on a number of issues, but especially in these trade negotiations.
Well, Ollie, just walk us through what the mood on the ground is, because, I mean, as we were watching the first round elections and then, of course, the developments over the weekend, this was a very tight race. What does it feel like to be in Warsaw right now?
Yeah, it was extremely tight race. I mean, we were at the square here yesterday. This is the presidential palace. This is where the president will inhabit for his next term within Poland. There was, a small demonstration. Everything was really quite peaceful. We saw at one point a big poster being rolled out for the centrist candidate because, of course, in that first early election poll, he was sort of slated to win by, a couple of basis points. That reversed overnight, and that is what you had this morning with this sort of turnaround. So this is an election that was won by less than 1 full percentage point. So, again, coming down to the wire. And for Donald Tusk, who's running on a very ambitious reform agenda, he was elected in 2023 after 8 years of law and justice right-wing politics. He basically will be frustrated now for the rest of his term because the president here has a great deal of veto authority, has a lot of authority also over the central bank appointment. They choose who is in the central bank. And there's been a lot of discussion, a lot of disagreement, we should say, between the finance ministry and the central bank. The finance ministry has accused the central bank basically as pulling for the other team politically. And these are the kinds of tensions that you're going to continue to see here in Poland in the next months and years.
Okay, Bloomberg's Oliver Crook out of Warsaw. We thank you. Headaches for Tusk ahead, but good news for the MAGA movement, perhaps, after all of those losses in Canada, Australia, Romania. Does this embolden the likes of Viktor Orban in Hungary? A lot to keep an eye on there in Poland, not to mention the market impact. But we also need to factor in what's happening in the oil market. We were discussing what's been happening in Ukraine over the weekend and the geopolitical and trade risks ramping up and factoring into the oil story as well. OPEC Plus as well, hiking production by by less than some had feared. Let's bring all those threads together. We have Bloomberg's Anthony DiPaola with us now. Anthony, I wonder what you make of these oil price moves this morning, up despite that production quote increase. Is it that we're focusing on the geopolitics here, or is it because the increase was less than some had feared?
Good morning, Lizzie. Yeah, we are looking at a lot of geopolitical factors in the oil price for sure, but we're also coming back from some pretty weak performances in the past week. So oil has been hurting over the past month or so, and it's really been on the back of that increased OPEC plus production. But the markets have gotten kind of used to that amount of increase. So we're going to be seeing another 400,000 barrels a day coming out of the group as they roll back those production cuts. Some people had expected, and there were reports going into the weekend, that OPEC Plus might try to increase even more than that 400,000 barrels, and that would have weighed on markets coming into today. So the fact that they didn't do that, the fact that they stuck to expectations was a little bit reassuring for the market. But remember, OPEC Plus had originally wanted to increase production by about 100,000 barrels a day as they rolled back these cuts, but they've decided to go in a little bit harder into the market, and that's for the last 3 months where they've made these decisions, that they've decided to go in, instead of that 100,000 barrel a day increase, they're going in by 400,000 barrels a day. So that's a lot more oil coming on the market as they try to get back some market share, as they see also geopolitically the Trump calls for lower prices. So it seems like they're taking kind of that view. The prices are going to be a little bit lower for a little bit longer. Let's get some market share back. Let's take some share from, say, U.S. shale producers, some producers in Brazil, some of those other non-OPEC countries that have taken back this market share. So that's what we're seeing in the market as they do kind of get back in a period where there is still that pre-summer demand that is propping up prices as well.
Well, Anthony, you talk a little bit about kind of the factors that create a floor when it comes to oil. Let's talk about the factors that create a ceiling when it comes to oil price. That, of course, is that tariff uncertainty. Very quickly, if you can, talk to us about just how much that tariff uncertainty is priced in to the oil market.
Yeah, well, that's been having oil prices bounce around pretty much since January, and then we did see them take a leg lower as OPEC began ratcheting up their production. So I think that what the issue is going forward is going to be, this uncertainty continuing to weigh on prices. But as we get beyond the summer, we're also going to see weaker demand as well, too. So that's going to be an impact, and that's why we're seeing lower oil price forecasts for the second half. So it's a little bit more of a bearish outlook. We don't see stockpiles building now, which is what OPEC sees giving them the freedom to do these increases, but that should start weighing on the market as demand starts to weaken towards the second half, according to the forecast that we're seeing, and that's why we're seeing some lower price forecasts, Grady.
Anthony DiPaola in Dubai walking us through the push and pull, the range that we're seeing oil trade, and we thank you so much for walking us through that crucial piece. He made a key point there that you are starting to see this bearishness in the oil price, but that is actually positive news for the Trump administration, or at least touted as it shows up at the pump in the U.S. And also good news, perhaps, for the airline industry. Coming up on the program, we're live at the IATA World Air Transport Summit in New Delhi. If you're wondering where Guy Johnson is, that's where he will be reporting from today. Shortly, we'll be joined by the Air France KLM CEO, Ben Smith. But as we head to the break, I just want to leave you with a little bit of sound. IATA's Director General speaking to Guy earlier.
Well, when I look at things, I think some of these events that we're seeing at the moment are short-term in nature. And therefore, they're not going to have a long-term impact on the growth of the industry. What I believe is that demand for aviation, demand for flying remains strong, and that will continue.
building another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Let's take you to one of our top interviews now. The US airline Delta says that it's expecting travel demand to recover in the second half of the year. That's after price-sensitive passengers in the US pulled back on spending as the economic climate worsened. The CEO, Ed Bastian, spoke to us exclusively at IATA's AGM.
Year over year, though, demand hasn't fallen. Demand's pretty flat, and I expect in the second half of the year, it hopefully will tick up a bit.
In terms of being more specific about where we are seeing the uncertainty manifesting itself the most, is it businesses? Is it consumers? Is it front of the plane, back of the plane? Yeah. Is it company CEOs saying, actually, I don't know, I'm going to sit still, I'm going to wait and see what happens next, so therefore I'm not going to travel as much?
It's predominantly in the U.S. marketplace, predominantly in the main cabin section of the plane amongst our most price-sensitive customers. Business traffic is holding up. It hasn't fallen. It's again hasn't grown as much as we hoped. But this time of economic uncertainty is a little bit different than a recession. In a recession, you'd have businesses pulling back on cost and pulling back on travel and making some short-term tactical decisions. When you have the nature of the uncertainty we have, which is a little bit more geopolitical in nature, businesses have to be traveling. They have to be out with their customers. They have to be out seeing what's happening in the marketplace. So businesses are still traveling.
Does that apply to the North Atlantic?
Yes, absolutely.
What are you seeing at the moment on the North Atlantic?
North Atlantic is doing well. The main cabin of our coach cabin, there's a little more price sensitivity in that section, but on the front end of the cabin, those yields are strong and the demand is strong.
Is the dollar having an impact? Weaker dollar? Are Americans traveling less, I guess is the question I'm really asking.
No, we haven't seen that. We're about 80% of our point of sale is U.S. going across the North Atlantic, and that's holding in there.
We're sitting here in India. You've just announced a partnership with Indigo, the huge low-cost carrier, run by Peter Elbers here. Is there an opportunity that you now have to maybe diversify? The markets that have done well historically, recently for you, are you looking elsewhere? Are you starting to widen the lens a little bit in terms of where you think the growth will come from? And does Indigo fit into that kind of framework?
Indigo absolutely fits into that framework. And we were talking earlier, this is our centennial year, our first 100 years of flight. And when people ask, what are you going to do in your second 100 years? First thing I tell people is that we're going global. Right now, we're about 2/3 domestic, 1/3 international. I would hope over the next coming decades that we at least level it out and maybe even flip it to more international opportunities than domestic, because you see countries like India that are growing significantly with great airlines like Indigo that's going to become a partner of Delta's. And when you think about what we can do in terms of bringing growth to the future, it's great.
The Delta Airlines CEO, Ed Bash, and they're speaking exclusively to our very own Guy Johnson. And Guy, of course, joins us now in case you were missing him from New Delhi. He's, of course, at the IATA World Air Transport Summit. Guy, we were just listening to your conversation with Ed Bastian. Who do you have for us now?
Well, we've actually got one of Ed's partners, Ben Smith, the group's CEO over at Air France KLM. Actually, Shai Weiss is waiting in the wings as well. Another part of that alliance as well. But Ben, it's great to see you.
Oh, great to see you too. Yeah.
Thanks for the time. Look, you updated us recently on what was happening in the demand story. Any change since then? What's happening?
No, things are steady, as we've been saying publicly for quite a while now, and we're reassured that our premium demand is holding across all of our sectors, and in particular the transatlantic, the North Transatlantic. And we're seeing premium hold and economy, the demand's there, but we've had to lower yields to fill the airplanes. But the fuel prices come down.
Is fuel compensated?
Yeah, it's a good balance.
So do you think fuel's sort of down here for a while?
I wish I were an expert at predicting. We're hopeful, but all indications are it's not moving.
But if demand continues to soften, you're going to be able to use that fuel lever to maybe lower fares, stimulate a bit of demand. Is that going to be what the strategy looks like?
Well, I think we're on a very clear trajectory for our group. We were not in a good position in 2018. We lived through COVID, and we restarted the same strategy that we had before COVID, and it's working. Like Air France in 2023 had its best year financially in the history of the company. 2024 we had the Olympics, which kind of was an anomalous year, and then this year looking good so far. We have the U.S. that wasn't predicted, but as I said, demand is still strong in premium, and we're a premium airline.
So, but the back of the plane is, so there's no update. The back of the plane is kind of as it was, i.e. there's some signs of weakness in that space.
Yeah, we're seeing 2-3% softness, and we have to stimulate with lower pricing.
In terms of the U.S. markets, are you seeing? Is the weaker dollar, stronger euro, putting off maybe some U.S. travelers coming into Europe? Is that a factor that we need to think about through the summer?
Well, look, France is still very popular for Americans. We're seeing that. We're hearing that. Is the dollar making a difference in the attractiveness of France or Europe? Yet to be seen. The Netherlands, it's not the same size of the market of France. Pretty steady. But Paris it's amazing, and the volume is good, but the premium is strong. And if you just not only the airline sector, but if you look at the rest of the hospitality industry with hotels, with the gourmet Michelin-starred restaurants, they're doing well as well.
There is some evidence talking. If you talk to the hotel groups, they say though that there is some evidence that Europeans are being more cautious in terms of traveling to North America. Any evidence of that?
As I said, premium is holding, which is most important for us. We are disproportionately premium, at least at our Air France subsidiary, and we're becoming more premium with the size of the cabins getting larger relative to the size of the airplane, so we're more exposed. And if you look at Air France KLM versus our two main competitors in Europe, we're less exposed to the transatlantic. We've got 25% of our capacity is on the North Atlantic, where the other two are, much, much higher.
How important will it be to your group that we see an EU-US trade deal?
That, of course, would be positive. How important it is, I think we need stability on knowing the impact of potential, price changes to have a kind of airplanes, engines, and supply chain.
What are you hearing? The talk around here is that we're going to be seeing price rises. That ultimately we're already starting to see them. There's a 10% tariff kind of that's already on. That is starting to feed. Are you starting kind of witness that? Is there evidence of price pressure coming through in the supply chain?
Yeah.
Like it could be spare parts, it could be new engines, it could be, I'm not sure where it's going to be.
Yeah, spare parts, we're starting to hear, see, get notices that there are increases. Engines a bit early, and the bulk of our orders, the vast majority of our new airplane orders are with Airbus.
Yep.
So that's not a subject as of today.
Right. But, and would you be concerned, say the tariff level, like at the moment it's 10%, there's a baseline 10%. We're coming up on some key dates. So, like, what's the difference between 10% and 20%? Like, obviously, there's a kind of mathematical figure there, but in terms of just the message it sends about the relationship, the interrelationship between European business and US business, like, how important would that be? Would you see a drop-off in business travel? Are you already seeing a drop-off in business travel? Is there an uncertainty that is beginning to manifest itself there?
When I said premium, I lump in business traffic.
Right, okay.
So it's all traffic in business class or La Première, premium economy. So I said that's holding. And what we see going forward is also holding. So any risk or, I guess, uncertainty around the impact of tariffs, where a lot of businesses are worried. Of course, we look at it every single day. As I said, the most important traffic for us is holding, and we're very happy about that, and we're quite relieved. Now, things could change, but as of today, premium is good.
Just give me a quick sense of where you are with M&A. Like the TAP post-election, we're all wondering what happens next. I was speaking to Luis a few minutes ago at IAG, get his take on it. What's your kind of view on what's happening there?
Well, number one for us is moving forward to a majority stake position in SAS.
Yep.
So we have 19% today, and we have the exclusive right to go to majority. So that's in the works. It's just a question of timing when we'll do that. And then on the Iberian Peninsula, you know, the TAP sale with the constant, the uncertainty with the government, you know, what the government is looking for, under what conditions is still unknown to us. And, you know, once that's made clear, we'll make a decision whether we can fit those requirements and whether it's of interest to us. In Spain with Air Europa, we've been in extensive negotiations with Air Europa. We're not anywhere near an agreement, so I have nothing to tell you today.
Okay.
But you know, the Iberian Peninsula is an important market for us. But Latin America is key, and you know, if we can find something that works on the Iberian Peninsula and it's positive, for sure. If it's too much risk or it's too expensive, then no, we'll do what it takes to maintain our position in another way.
Sounds quite straightforward. Ben, it's great to catch up. Thank you very much indeed for dropping by to see us. We really appreciate it.
Okay, thanks, Guy.
Ben Smith, CEO of Air France KLM. Critty, back to you in the studio.
All right, Guy Johnson there reporting from New Delhi, talking to us a little bit about the M&A picture in the airline space, but also, of course, the consumer as well. Lizzie, we're going to get plenty of those checks in terms of those geopolitical pieces that are driving this market narrative. Guy was talking there about the consumer. I'm going to talk about financing conditions later in the week at super return, but there's plenty of other data points to keep our eye on this week.
Yeah, we've got US ISM manufacturing numbers today. We've got the Chinese Kaisha manufacturing PMI tomorrow. Wednesday, we have rate decisions out of Poland and Canada. Thursday, we have Friedrich Merz, the German Chancellor, meeting Donald Trump, of course, and we also have that ECB rate decision on Thursday, and of course on Friday is also US Jobs Day. It's a plenty busy week, and you've got super return, as you say.
And I've got super return. We're going to talk about the private markets. We got some really great exclusive conversations coming up on this program. That does it for the opening trade today. Pulse is up next. Stick with us. This is Bloomberg.
morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg. At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Tariff tension tests investors as China and the U.S. accuse each other of violating last month's trade deal. A nationalist candidate backed by Donald Trump wins Poland's presidential election in a blow to the country's pro-EU government. Plus, Ukraine stages a dramatic series of drone strikes deep inside Russia, while Moscow launches one of its longest missile and drone attacks. This ahead of planned peace talks today. Now, first thing is first, we are Monday, so we always check the markets. There's quite a lot going on, not only because of these trade tensions where stocks are a little bit lower. You can see S&P futures down 0.6%, but also quite a lot going on with oil on the back of the OPEC Plus adding a surplus, 64.29. Look, euro dollar 114, and then the U.S. 10-year yield at 4.4399. Jamie Dimon gave an amazing interview where he says, look, his main concern is really something happening with the auction market or treasury. So always look at that. Let's also take a look at the European markets map. And you see there is quite a lot of red on the screen. Here, the FTSE down 0.1%, a little bit more pronounced falls with the DAX and the CAC 40. Now, the couple of things that we're watching out for is, look, the flare-up in global tensions, where they go next, and again, some of the risk moves that we're seeing in markets. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone. Happy Monday. Welcome to The Pulse. I'm Francine Lacqua here in London. Now, China is accusing the U.S. of violating their recent trade deal, promising to take measures to defend its interests. That's dimming the immediate prospect of a leadership call that President Trump is seeking. But U.S. Treasury Secretary Scott Bessent remains optimistic.
That when President Trump and Party Chairman Xi have a call, that this will be ironed out. So, but the fact that they are withholding some of the products that they agreed to release during our agreement, maybe it's a glitch in the Chinese system, maybe it's intentional. We'll see after the president speaks with Party Chairman.
Well, we're now joined by Rosalind Matheson, our EMEA News Director. Ros, I guess it was always going to be quite a lot of trade tensions that flare up and then go back down. Are you surprised by what we've heard, both sides, China and the U.S., accusing each other of breaking the deal?
Well, it just shows how complex this relationship is, and it's not just necessarily about trade itself, because also in all of this, China is accusing the US of revoking the visas of students who want to go there and study. We had the Defense Secretary in Asia on the weekend at a speech in Singapore saying that China is eyeing, action against Taiwan. And so you put all those things together, trade, defense, other parts of the relationship, and keeping trade on an even keel becomes even more complicated. And so these ebbs and flows, as you say, are unsurprising. We've seen this pattern over and over again. There's a bit of a trade understanding between the US and China, often brokered by direct conversation between Xi Jinping and Donald Trump, or Xi Jinping and Joe Biden, perhaps even a dinner, and they resolve it. It's all okay for a little bit, and then it goes off the rails again. And so this is not uncommon in a relationship this complex and fast-moving. The question is, what's it going to take to get this back on an even keel?
Yeah, and of course, I mean, because the two economies are so big, it involves everyone in the world. And then the EU, just a short time ago, we had this headline saying, the EU will probably curb China's access to medical devices procurement. So does the EU now need to choose sides?
Well, it's difficult for the EU as well, because this was an investigation that started back in April, I think, and now they've made a decision. It's obviously quite a targeted action. Yeah. It's about these concerns, again, around supply chains and procurement when it comes to Chinese companies, and it's about the medical sector. I mean, that's not insignificant, but obviously at the same time, the EU's trying to balance the relationship with China. We can see, the narrative from EU officials about needing to keep the door open to China, especially, again, you've got the trade tensions, conversely, with the US. So the EU is trying to have a relationship with China, and like everybody, trying to put things in compartments, a bit like the US. So you put this medical procurement scoop, which we just broke the news of a short time ago, in one compartment, but you keep the relationship more broadly going. And that's the difficulty, is how to nuance all of that.
Ross, thank you so much, as ever. Ross Matheson, they're very good, of course, at unpicking everything with clever nuances. Now, the International Airport Transport Association's annual general meeting and World Air Transport Summit begins today in New Delhi. The gathering in the Indian capital comes as the aviation industry grapples with the threat of Donald Trump's tariffs, potential supply chain problems, and a slowdown in transatlantic travel. Let's head to New Delhi, where Guy Johnson is standing by with a guest. Hi, Guy. Good morning.
Good morning, Francine. Thank you very much indeed. Yes, we are joined now by Shai Weiss, who is, of course, the CEO of Virgin Atlantic. Nice to see you.
Nice to see you, Guy.
You told us a few weeks ago that there was some softening in the North Atlantic. Yeah, what's going on now?
Yeah, I think that it's a common question. I think since tariffs were announced on the 2nd of April and until the stay of execution on April the 9th, we have seen some softening. But it's rebounding a bit. It's hard to determine what the slope of the rebound is.
Yep. What does it look like right now?
Yeah, so improving versus the April period. Premium strong, leisure a bit weaker, and really concentrated in the United States. I think a bit of uncertainty.
So when you say concentrated, what do you mean? You mean US travelers coming into Europe?
That's right. Yes.
Okay.
I think
is that a dollar-related story, or is that?
No, I don't think it is. I think it's literally an uncertainty-related story. And travelers like certainty, whether you're a business or a leisure, whether you're going to meet family or friends, you just want to know that things are just going to be as you expected them to be in terms of your savings. What are you spending your money on? It has improved. A bit of, I think you've heard the theme across, a bit of weakness, a bit of softening, I would say, in the yield side of things. So volumes are there. It's a bit of price, but it's improving day by day right now.
How much room have you got on price? Is fuel helping? How quickly can fuel help?
Fuel is very stable at $65. The pound is a bit stronger versus the dollar. So all these things in the balance help airlines. But fundamentally, we need strong demand to continue, which we're seeing that emerge after a very strong start to the year.
Was there any effect off the UK-US trade deal? Did it in any way meaningfully change that degree of uncertainty?
I'm going to be kind on the US-UK trade deal. I think actually we're in India. More significant is the India-UK trade deal. Okay. We're now at the 4th largest economy here in India. For us, it's 25 years of flying here, 1 million seats. We've really grown 350% over the last 5 or 6 years. I think this is more meaningful as India moves from just a service economy to a manufacturing economy. This is really significant for the UK.
The airline, then.
Virgin India.
You got Virgin Atlantic. That was the priority. Are you saying that now?
But I think, but you've known, we've just announced actually yesterday a partnership with Indigo, together with our partners Air France and KLM. This is really about taking account of the strength of our joint venture and expanding it.
How big could this market be?
You know, there are about 4.5 million passengers a year to the UK, about 7 million passengers to the US. Less than 10% of the population here have a passport. I think this can be very, very big.
Okay, so this could be a very big market. I want to take you back just to the US for just a moment. Do you get a sense that the uncertainty is, we just don't know what is going on, but do you think, I'm trying to isolate which factors are the most important at the moment. Is traveling, it's just, but is traveling to the US just more difficult now, more nerve-wracking, more...
Especially out of Europe, we've heard that there is some negative feelings towards the United States. Of all the countries in Europe, and I count the UK in Europe, we are the least impacted. You know, people love traveling to the US, whether it's for business, of course, New York, San Francisco, Los Angeles, but also to Florida. So I think the operative word here is sentiment. Travel in all its types is impacted dramatically by sentiment and certainty. Inward investment, just, you know, what are the rules of the game? And I think we're just waiting to see what happens in July after the 90-day pause on tariffs is. But I already see that people, even in this period, they adjust very quickly, and we're seeing a rebound in volumes and in price affect all types of travel.
In terms of the other story that I'm hearing around the halls here is that costs are going up. That tariffs do actually mean higher prices for spare parts, for engines, for you name it. It's going to... How inflationary do you think it could be?
Look, this is a question really for the economists, but there have been...
Aviation CEOs are basically economists. You have to be economists. You have to
be economists. You're not going to let me off the hook on this one. Okay, so I'll take the question and answer it. I think it's fair to say that prices have gone up, of course, over the period through the pandemic. We're entering into a period of more stability in the supply chain. You know, engines are late, planes are a bit late, and we're seeing a recovery, but the tariffs, no doubt, will make it, will have an impact on the price of goods, the price of transport, you know, changes of production. But these things take time. They don't adjust overnight. So now I think we're just going to have to see how it settles, and then people adapt relatively quickly.
But it sounds like you're also telling me that you're going to deprioritize the US. Is that fair?
No, and you know, for us, it's not even a possibility. Neither do we want to do that. It's Virgin Atlantic. We always say it wouldn't be Virgin without the Atlantic. 60 to 70% of our capacity is to the United States. It's our more profitable and our more successful. And no, I don't think we need to deprioritize. But having said that, you can see the growth into India. We've announced, of course, we started a flight to Saudi Arabia. We're going to start a flight into Seoul next year in March. Cancun is coming. We launched Toronto. So a balanced approach is the right approach.
Okay, but there is an emphasis. Ed Bastian, I had the same conversation with him. Your good friend. He was talking about, he sees he's got 100 years. You've got 25 years. He sees the next 100 years as being outside the United States as being the growth opportunity. Is the growth opportunity outside of the United States now?
Look, first of all, 40 years of Virgin Atlantic, 25 years of flying into India, and yes, there is growth. There is growth in India, and that's why we bet on it. Actually, in 2019, we looked at our portfolio and figured that we could really only support one amazing growth market, and made a bet on India to the detriment of other locations, including China. It happens to be that the bet seems to be working out. We now have 5 daily flights into Mumbai, Bengaluru, and Delhi. With our partnership with Indigo, we connect into 36 domestic destinations. So the sky is the limit, and when Indigo is now flying into Manchester, into Schiphol, we can connect these passengers. 40% of the passengers flying out of India connect onwards, either in the UK or the United States. So I think it's really about the connectivity, it's about the partnership with other airlines, and of course it's a betting on fast-growing markets, which is India.
Not China, though. It's interesting that the world seems to be shifting. This is now, maybe just because we're all here, but this is being perceived as being the big growth market. India is the growth market. China is not the growth market. Am I looking at it the right way?
I wouldn't write China off. You know, it's still the second largest economy, and there's a long way for India to catch up to China.
Sure.
But I think in terms of momentum, the momentum is very much here. It's palpable. You can feel it. You can see it. And you can hear the conversations. If it was an outsourcing conversation in the past in the technology sector, it's now potentially a manufacturing, aided by, of course, trade deals, aided by tariffs, which rebalance the world economy.
Shai, great to catch up. Nice to see you. Thank you. Sorry to get my dates wrong, but you corrected me, has it? Shai Weiss, the CEO of Virgin Atlantic. Thank you very much indeed. Francine from New Delhi, thank you very much. I will hand things back to you in London.
It was a great interview, Guy Johnson, with the chief executive of Virgin Atlantic. I learned especially on this India-China divide. Now, coming up, we'll check in on markets with Tunde Lawal from Barings as the U.S. and China accuse one another of violating their trade war truce. More on that next, and this is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Growing trade and geopolitical tensions are again prompting investors to hold back from taking risky bets. Let's bring in Bloomberg's Valerie Teitel with the latest. Val, what do you have?
Hey, it's a risk-off move across markets. Global equity markets are in the red. You got the U.S. market, the European market, and even the Asian markets in the red this morning. We also have the gold also on the front foot. Take a look at what's been going on, up near 2%. This is a big standout mover on this risk-off move today. That's gold up 2%. The one asset, though, that is not responding like it normally should in a risk-off move is the U.S. dollar. This is the Bloomberg Dollar Spot Index. We're on a back foot, down 0.5% for the broad dollar index. And that's after the Bloomberg Dollar Spot Index has now fallen for 5 straight months. So momentum really is on the back foot for the U.S. dollar. I want to end on one more thing, and that is the long end. What's going on in the long end yields? Treasury yields, German yields, and gilt yields all rising quite steeply in the long end. Those 30-year gilt yields up some 6 basis points. So some weakness across fixed income as well. Francine.
Valerie, thank you so much. Valerie Teitel there with the very latest market moves. Now, we're also joined by Tunde Lawal, head of EMEA Corporate Credit and EM Corporate Debt at Baring, and Brendan Murray, our global trade czar. So Brendan and I were joking that it's always up and down. Like something seems to go well, and then, well, they're not, as happy as they could be. Tunde, just talk to me a little bit about how the market is reacting, because the market seems to be more on an optimistic mood in general, and then in trade like days where there's tension, they sell off, but they don't sell off hugely. So what are they actually pricing in?
Well, I think markets are telling us no one really has a crystal ball and everything seems a bit uncertain, right? Because I think that's the thing, that this trade wars are really bringing so much uncertainty to everything. Some days, historically, when we see treasuries sell off, it's because maybe there's, treasury yields go higher, it's because maybe there's strength of the U.S. economy, and so treasury prices go down. But recently, the sort of rising Treasury yields has been more a sign of concern around U.S. fiscal policy. And so that's making people a little bit concerned where Treasury yields are going up, dollars going weaker. It's sort of that correlation's breaking down. I think it's the weakest correlation in about 2 to 3 years as well. So markets are telling you that they're a little bit confused. And so people are sticking to buckets of what they feel comfortable with. And so if you're looking at credit, then you're sticking to, say, high quality end of credit. And if you're looking at sort of private credit as well, you're sticking to sort of well-known issuers in that space. So I think that's what the market's a little bit confused.
Yeah, I like that. I mean, honest markets, actually, because a lot of us are pretty confused. Brendan, when you look at trade, it was never going to be plain sailing ahead because of this tension between the U.S. and China. Is it better than you expected or worse than you expected?
It seems to be about the same as we expected. This was 3 weeks ago. The two sides, the U.S. and China, got together in Geneva. They said, we'll have 3 months to work this out. Here we are 3 weeks on, and they're still not even really talking. In fact, they're pointing fingers at each other, saying, you're not abiding by the agreements that we agreed to. So I think it's a real test right now. President Trump seems to think that the tension and the escalating things drives the Chinese President Xi to the negotiating table. That seems to be a fundamental misunderstanding of what would bring the Chinese to the table, which is mutual respect, calm, and some sense that they can accomplish something meaningful and positive. And right now, the tone for that is just non-existent.
So what would bring the Chinese back to the negotiating table?
It would seem, well, I can tell you what won't bring them to the negotiating table, and that is these geopolitical things that they're doing with student visas in the U.S., with export controls on Chinese technology, the kinds of things that, escalate tensions rather than bring them down.
Tunde, I mean, as you say in your notes, there's obviously winners. I say obviously, actually, it's not clear who the winners and losers are because we don't exactly know where these tariffs or trade end up. But again, how do you identify the potential winners? Is it more countries, emerging markets? And is that a good way how do you know the entry point?
Well, hard to know entry points, which is why I say you pick things that fundamentally you find you like and you think that they're strong. And so when we think about the way we've sort of done preliminary analysis in terms of winners and losers is we're thinking of if there's tension between U.S. and China, what does China buy from the U.S. and what does the U.S. buy from China? And in that sort of scenario, you look at the guys who are exporters of commodities like the soybeans, the corn, things like that. Brazil, Argentina, they export beef, they export soybeans, all that. They stand to benefit from that. You look at places like India where it might be a place where you could transfer some of the production of iPhones and tech and some of the things from China into India. So there are some places that could be winners and losers there. And so that's the kind of analysis that we've done where we've picked companies in certain sectors that would benefit from that. And then regionally as well, I think the GCC is largely immune from the trade wars, right? Apart from the exposure to commodities, the GCC is largely isolated from this. So again, there are pockets of the GCC that you can look at because they actually have their own idiosyncratic events going on where they're transitioning from being predominantly hydrocarbon economies into more diversified economies. So there's a lot to do in Saudi, there's a lot to do in Qatar, there's a lot to do in the UAE as well.
How do you look at inflation? There does seem to be a narrative from Fed officials in saying, look, they have this dual mandate, but actually they worry that inflation picks up in the third and fourth quarter. What does it mean for inflation in other parts of the world? And again, how you play it?
Yeah, so that's actually quite interesting. And I think the general expectation is inflation will tick up in the second half in the U.S., as you say, from this trade tensions. I think we haven't seen that data come through yet for April, but I think subsequent data should point us to that. But in the rest of the world, I think China has been exporting some of that deflation. I think Europe has been a big beneficiary of that and should continue to be a beneficiary of that if you get trade tension between China and the U.S. and more of the goods find their way into Europe. That benefits Europe, actually. I think today or this week we're expecting the ECB maybe does 25 basis points, but we're expecting that the preliminary numbers will show that inflation in Europe is actually closer to the 2% target. And so that actually gives a bit more of a tailwind to Europe in terms of ECB being able to pause. And then generically within the rest of EM, we're actually seeing a lot of the EM central banks actually on hold or actually cutting. So inflation has been relatively more muted in other parts of the world outside of the US where we expect it to go up. So that's the kind of way we're thinking about inflation.
And I'll ask about Europe in a second. But speaking of Europe, we had this headline earlier today saying, look, the EU is poised to curb China's access to medical device procurements. But this is not because of the immediate trade war, right? They've been looking at this for quite some time. So it's retaliation for, I mean, how does it fit into the general trade wars?
Well, it fits the textbook definition of reciprocity. The European Union would say, look, China doesn't allow us a fair shake on local procurement, so we're gonna do the same thing with China. So it's another take on the reciprocal. President Trump uses the word reciprocal tariffs, and he imposes them, unilaterally. The European Union, as you said, has taken almost a year to investigate this, and now they're coming out with, or they're voting on, it sounds like, and our folks in Brussels have the scoop on that today, that they're poised to implement that reciprocity.
I mean, a lot of chief executives from Europe and other places, I always ask them, like, do you have to choose between the U.S. and China? And they all say, absolutely not, we can do both. Can they really?
Yeah, it points out this interesting dynamic where the focus is on the trade war is always on Washington and targeting China or targeting the EU or targeting other countries, where the EU is really caught in the middle and is trying to balance that and follow the de-risking strategy, the sort of strategic autonomy as opposed to decoupling, which is what you would hear from the China hawks in Washington.
Tunda, where do you put Europe in kind of your general appetite for markets?
I think Europe and emerging markets actually stand to benefit from the uncertainty that the U.S. is fostering at the moment. And I think I saw a stat from your Qatar forum from last week where someone said of every dollar that had been put or invested over the last 5 years, 80 cents of every dollar went to the U.S. And so it was only 20 being assigned to the rest of the world. And I think now there is a case for diversifying some of that 80 cents, right? And it's not a case of taking cash out of the U.S. necessarily. It's just being more aware and addressing that disproportionate allocation, and I think that makes sense. And I think that's where Europe comes in, because Europe, at the start of the year, I think we were quite dour on growth prospects in Europe, but that's since turned around somewhat since we had German and wider EU defense spending plans coming through. So there's some sort of tailwinds coming through. If as you say, Europe doesn't pick between US and China, Europe tries to sort of stay the course between both, however difficult that is, then potentially, you have certain pockets of Europe that benefit from that. Same thing for emerging markets as well. I think there's so many different good things for emerging markets. Corporate fundamentals are very strong in emerging markets. You've got sort of much lower starting debt levels. Central banks are cutting rates, which gives you a good tailwind. And there are really very good sectors within EM, as well as Europe as well, that benefit from a weaker dollar as well. So you focus on your domestic sectors. You go your domestic tailwinds from lower rates domestically. You do banks, you do utilities, you do infrastructure. There's so many things to pick from that actually it's a good time to be doing Europe and EM.
Yeah, and this is, corporate credit.
Correct.
It's corporate credit. So, in banks, there's so many questions about consolidation, things like that. Do you put that to one side, or do you also have to follow the kind of individual, companies and what they're doing in terms of possible M&A?
For the banks, generically, the themes are, so long as you're seeing credit growth coming through, right? So at the start of the year, or so far year to date, we've seen much stronger growth in peripheral Europe versus northern or core Europe, right? So the banks in peripheral Europe have actually outperformed core Europe. And so you're picking up on credit trend growths, what's going on there. And we've seen that consolidation happening. That's helping. The sweet spot within the European banking sector would be probably the tier 2 space. And then within emerging markets, you've got lots of different countries where you're actually having very strong credit growth. The GCCs, as a region, for example, very strong credit growth across the UAE, Qatar, Saudi even. We've seen a lot of Saudi bank issuance coming through. Same thing, Mexico as well. Credit growth slowed down a bit, but it's still very good as well. And, we've seen some supply coming out of Chile, Peru, places like that. So there's a lot to pick from. That's the beauty as well of, say, sort of something like emerging markets, is the underlying diversity that the asset class brings. So you've got 80-plus countries to play with.
Tunda, thank you so much. Tunda Lawal there from Barings, and Brendan Murray, our global trade czar. Two very actually busy analysts and team leaders. Now, coming up, a pro-Trump nationalist wins Poland's presidential election in a potential dent to Prime Minister Tusk's ambitions. More on that next. This is Bloomberg.
makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think that all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francie Lacqua here in London, and these are your top stories. Well, tariff tensions test investors. China and the U.S. accuse each other of violating last month's trade deal. A nationalist candidate backed by Donald Trump wins Poland's presidential election in a blow to the country's pro-EU government. Plus, Ukraine stages a dramatic series of drone strikes deep inside Russia, while Moscow launches one of its longest missile and drone attacks. This ahead of planned peace talks today. Now, more on that story now. The conflict between Ukraine and Russia has ratcheted up, but just as the two sides are set for a second round of peace talks in Istanbul. For more, let's bring in Greg Sullivan, our Russia economy and government editor. Greg, thank you for joining us. An escalation on both sides. What do we know?
Well, that's right. Over the weekend, Moscow launched one of its longest and largest drone and missile barrages against Ukraine. They've been hitting Ukraine pretty hard in recent weeks, but it was actually a Ukrainian attack on Russia that was quite interesting. It was potentially the most audacious attack into Russia, and President Zelensky said that it had been in the planning for over a year and a half. Basically, Ukraine took about 117 drones, which they had snuck into the country, sometimes hidden in trucks, launched against these strategic bombers, which will be very hard for Russia to replace. There are differing accounts of the damage. A Ukrainian official said about 40 of these strategic bombers were damaged, whereas the defense ministry in Moscow said that they only acknowledged several aircraft. Military bloggers that tend to be pro-Russian said that it could have been 13 bombers, but nonetheless, these are very hard to replace because they have foreign components, and sanctions prevent Moscow from getting their hands on that technology. So it was a very audacious move and likely to be very painful for Russia moving forward.
Greg, do you expect anything to come out of the peace talks?
Well, that's the peace talks that are starting today in Istanbul. Of course, they follow the peace talks that happened earlier in May. Those did not produce much. What we saw was an agreement to exchange prisoners, but Ukraine has been demanding a ceasefire that Russia has so far refused. Russia has largely stuck to their maximalist demands, and so those talks made very little headway. It's probably going to be a similar situation coming out of these talks. Not much progress is expected. Ukraine has been calling on Russia to agree to that ceasefire, but Russia keeps saying that they want a bigger solution to the end of the conflict that includes many of their demands that will be very hard for Kyiv to swallow. So while it is progress that the two sides are meeting despite these attacks, it's probably not going to produce any large headline agreements.
Greg, thank you so much. Greg Sullivan there with the very latest on Russia, Ukraine. Now, pro-Trump nationalist candidate Karol Nawrocki has won Poland's presidential election in a campaign that's laid bare the political polarization within the country. Let's go straight to Warsaw, where Bloomberg's Oliver Crook joins us from the presidential palace. Ollie, good morning. So what's the mood on the ground? And what impact could Nawrocki's victory have on Donald Tusk's government?
Yeah, Francine, it's been really quite a roller coaster in terms of political developments over the last 24 hours. When we got in yesterday, you know, we got the first exit poll about 9 p.m. last night, and it was showing that the centrist candidate was actually ahead there, not by a whole lot, admittedly, but then by the morning and this morning still, we found that actually that result was inaccurate. It was totally reversed. In fact, it was the right-wing candidate from the Law and Justice Party that is being supported that actually won the presidential election. As far as sort of domestic Polish politics are concerned, this basically will create a situation that you've had for the last 2 years under Donald Tusk's premiership, where you have basically a stalemate between the presidency and the prime minister. The prime minister is sort of the main office within Poland, but the president has a lot of power to veto legislation and be really involved on a number of different issues. He's a representative, for example, of Poland to NATO. So these are the kinds of ways in which you are expected now to have a prolonged era of sort of political paralysis here within Poland, particularly at a time when Donald Tusk came in to really set out a very sort of ambitious liberal agenda that he's basically been unable to do for the last 2 years, in large part because of the sort of the holds and the sort of presidency not being in his control, and that is set to continue here in Poland.
What are the implications beyond Poland for the EU and European politics?
Yeah, so, you know, with a lot of these elections across Europe, you've had a lot of engagement in many instances with the Trump administration coming in and backing a certain candidate. You saw it with Elon Musk and J.D. Vance in Germany. You saw the same thing in Romania, and Poland was no exception to that, where you had Kristi Noem, the security advisor, the Homeland Security Secretary for the United States, who just showed up in Poland a couple of days after the first round of election and endorsed the right-wing candidate who has now won the presidential election, saying that basically the other candidate was a total train wreck, and that if Poland wanted to retain very good political ties with the United States and wanted to continue to rely on the United States security support, that they would have to basically elect this right-wing candidate. I'm not sure how much of a decisive factor that is going into this, but it shows sort of very clearly what the Trump administration is favoring, both on the question of sort of European conservative values, but also the fact that it creates more undermining of the sort of unity within Europe, where you have a candidate here and now a president within Poland that is much more Eurosceptical at a time when Brussels and the Europeans would really like to see much more solidarity, particularly as they face off in a trade war with the United States. That caught a blow here in Poland.
Ollie, thanks so much. Oliver Crook there with the very latest, of course, on this election and the implications so far. Now, the ECB is set to lower interest rates again this week, with euro area inflation expected to fall closer to the ECB's 2% target. Well, with us now, Jens Eisenschmidt, Morgan Stanley's chief Europe economist. Jens, thank you for joining us. I mean, there's a lot going on. I don't know whether there's a last cut coming actually this week before September, or what kind of levers the ECB is looking at.
Yeah, no, I mean, first of all, our expectation is that's not the last cut, but they will sort of slow down the speed by which the cuts take place. So we have actually the next cut in September, and then a last one by December at 150. Now, what they are watching, or what they are seeing? I think they will stress a lot the high uncertainty, which has not gone away really. I would also expect that there are further downside risks to growth flagged, even though the growth expectations, in particular for 2026, will be marked down. And of course, there will be a debate what to make of the inflation developments. It's clear, and I think we have heard that from council members, that inflation is set to go slightly below target, or maybe even significantly, depending on who you believe. But then the question really is what it will do after 26. Right. Will it go up again to 2, or will it stay below, which will be very important for the rate outlook?
But yes, I mean, first of all, is the economy in such a bad shape that it needs to be stimulated with rates lower than 1.75%? Because that feels quite a big deal.
Yeah, no, I mean, and first of all, I think it's all through the lens of inflation that you look at that. And then the second part, you look at whether growth is at potential or below. So basically, is the output gap opening, or is it closing? Our own forecast is that the output gap is actually not closing, it's actually staying where it is or getting wider. And then with inflation below 2, you can, of course, cut below 2%, which, broadly speaking, is probably neutral.
So do you think there is a danger that actually inflation persistently undershoots 2%?
You cannot exclude that from now. I mean, what you could see if you look at inflation, I mean, there are two things. Volatile components, FX, oil, point to downside risk, but they are volatile. And so you wouldn't want to give too much weight to them here. But then there's wage developments, which are really setting core inflation. Here, the German labor market is very important. The German labor market is weak. Yeah. Normally, at this time of the year, we see an improvement. It's not improving. Actually, that bodes ill for further wage agreements. We have it down to 2.4 next year. Euro area wages, all of which is still a tad above pre-COVID wages, but not that far. So there is a risk we go back to pre-COVID inflation dynamics significantly below 2%.
I mean, it seems like actually the market is extremely undecided just because of these tariff concerns that we don't know where they land. So is there a case to actually just pause until we figure out what tariffs do, or is it impossible because then you'll be too late?
No, I think that's exactly the sort of decision problem that the ECB is facing. They can't go too quickly, which is why we think it shouldn't be July. It will very likely be September that there's the next decision. At the same time, indeed, you can't decide too late, because then when it's too late, it's too late.
What's the worst scenario, that you're too late in cutting or that you're too soon in cutting, given the dynamics? Again, tariffs, look, the prospect for trade wars change every day, right? Today, again, the markets are selling off because of U.S.-China.
Yeah. Meanwhile, uncertainty is weighing on. Even if, in the end, the outcome is a better tariff rate than we currently expect, I'd say risks are to the downside all over. So from that perspective, to your question, I think the risk is rather that you're too late than that you're basically not staying put enough.
Yeah, and again, the landscape, as you rightly said, has changed so much since March. How likely is it that it could change significantly again until September? Or do you think at least now we have the overarching idea of what the global economy will live through?
Yeah, no, I think, first of all, I think it's certain that we have less growth than we had expected still in November, which had already some tariffs in. Yeah. Then the question you have to ask is there a significant upside left? Yeah. And we think not really. Of course, we do have an upside scenario in our recently released outlook, and a downside scenario, but the upside scenario is much more modest than the downside scenario.
Jens, when you look at the defense budget in Germany, when does it impact growth and inflation?
Defense tends to have a low multiplier, and you only over time, by rebuilding the defense industry, which is underway as a process, you might get to higher multipliers. So all of that means most of that should come significantly after 27. Mm-hmm. The other question is on infrastructure. That could be quicker, but here again, it takes time. So if you take this 500 billion, very simplistically speaking, which is the size of the program in Germany on infrastructure, there's this 12-year planning horizon, but it's only planning. Then the spending is over maybe 20, 25 years. So that gets you to a much lower per annual or annum increment in terms of spending, and probably only hitting the road after 26.
Jens, I know, as a chief European economist, how much do you look at U.S. move in treasuries and dollar? Because it seems that some of them are, if not irrational, certainly very violent, certainly when it comes to treasuries. But then the market's like, oh no, everything's fine, and they go back to behaving in a more normal way. Do you worry about an auction or like a market event in the U.S. that really infects Europe?
For sure, we have at least the market looking at the potential regime shift here. We just have published a piece looking into what would be dynamics if just, say, global reserve currency, percentages, shares, the euro would go up to 28 where it was in 09. And of course, that would give you significant euro strength, and that has negative repercussions for growth, significantly so.
I know, Morgan Stanley, the team saying that the dollar could fall some 9% on slowing U.S. bets. It had everyone in a tizzel in the newsroom. What are the implications for the rest of the world?
So, in general, a big shock to the system means adjustment all over, and I don't think that this will be throughout in just the lens of growth. If you look at it from the perspective of growth, it will be negative, just because of the adjustments to trade flows and so on and so forth.
Is there anything that the market is not seeing or not pricing in that you worry about in the economy?
Well, of course, so far, we have this problem that hard data is not really telling us the full story. It's not really falling off a cliff, And we are also trying to understand what is the extent of the adjustment of the economy. And of course, there could be more to come than what we are currently seeing. So from that perspective, yes, there may be further downside risks that are not fully acknowledged yet.
Yeah, but is that because of the cost of money? Is it something structural, or is it just because it's taking time to filter through you think it's just taking time?
Because the shock is so big. So you have the front loading that's typically seen as one of the key explanations for the strong first quarter. It could go on in the second quarter, and then you might come into thinking, at least if you look at the equity markets, which are more or less back where they have been pre-April 2nd, then you might come thinking, oh, it's all not too bad. But, there will be a hit to global sharing of labor, and that will be a hit to growth, for sure.
Yeah. And Jens, I guess I don't know whether, your job has become more difficult in the last 10 years because there's so much more money also in private markets, and that's much more difficult to measure. And so does that skew data that you look at?
That's a good question. From the academic literature that I know, I'm not aware of a systematic bias there. But it's true that for sure this is a debate in the market, right? Whether we have essentially a glut in liquidity that's actually making it harder to extract signals from equity prices, for instance.
Okay, Jens, thank you so much for joining us today. That was Jens Eisenschmidt, the Chief Europe Economist at Morgan Stanley. Now, coming up, oil gains after a smaller than expected output hike from OPEC Plus. We'll break down the details and talk Brent and talk WTI. That's next, and this is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Earnings season is here.
European earnings season in full swing.
They're coming left, right, and center.
It is the earnings season that is dictating the narrative.
Bloomberg is first to break the numbers.
The banking sector, that's the auto sector, HSBC, BBVA, BNP Paribas,
Continental, Ferrari.
All of them really delivering.
With the smartest insights.
I think the rebound that we have seen has been surprising.
The results hit another record high.
Continuing coverage on Bloomberg. Context changes everything.
Emirates President Tim Clark says the airline is seeing full flight bookings through the year. Now, that's despite global uncertainties that he says the industry is preparing to confront. Well, Clark spoke to Bloomberg's Guy Johnson.
We're just entering to the summer peak season. Our flights are all booked full. In fact, booked through to the winter. As far as the uncertainties, we're kind of used to all of this. I think the markets are so much more resilient now. They went through a difficult time during COVID, and that has strengthened their resolve to keep moving. I'm not alone in that. Every time I talk to other members of the community that we are all competing with each other, they say the same thing. It's so far so good. There have been some problem areas. We know about North America, Canada, to an extent the North Atlantic. But so long as there is a state of change, as we know that's going on at the moment, with regard to tariffs coming off, tariffs coming off, levels falling, levels increasing, I think people are just keeping their powder dry, waiting to see what's going to happen.
But that's not causing people to stop spending. They're still spending in the way that they were.
They are. They continue to do that at fair levels, which are very healthy as far as we're concerned.
Are you getting an inkling that you're about to see the manufacturers, the OEMs, the Boeings and the Airbuses and the engine manufacturers raising prices? Because they are being affected by tariffs at the moment. They are seeing that impact. Is that something that they're ultimately going to try and pass on to you?
Well, in the end, we'll have to have that conversation. I don't believe...
Do you expect to have that conversation?
I think it may happen, but they're not in a position at the moment to say exactly what is going to happen to their cost structures, because they don't know what the supply chain effect is going to be. If you have 140% tariffs in one day and then it's down to 10% the next day, they've got to just take stock and take a medium to long-term view as to what their costs are going to do, and then have a conversation with us as to what that may be. As far as we're concerned at the moment, they can absorb that. They need to absorb that. Until it gets to a point where it's not absorbable, if I can use that word, and then we have that conversation. But it's too early to engage and say your price is going up 10%, your price is going up 5%, etc. Because as soon as things change positively, then we would expect those prices to come off. So you get a situation where the negotiation with these vendors, the OEMs or whatever, becomes difficult, complex, and a little bit timely, and in the end it's time wasting.
Well, that was the Emirates President, Tim Clark, speaking to our very own Guy Johnson. Now, meanwhile, U.S. airline Delta says it's expecting travel demand to recover in the second half of the year. That's after price-sensitive passengers in the U.S. showed spending restraint in recent months amid a worsening economic climate. Well, the chief executive, Ed Bastian, also spoke to us exclusively at IATA's AGM.
I think in the U.S. structure, lower ticket prices is part of the reason we're seeing lower prices, as costs have come down. It's helping to insulate the fall off that we've seen from expectations on demand. Year over year, though, demand hasn't fallen. Demand's pretty flat, and I expect in the second half of the year, it hopefully will tick up a bit.
Well, oil prices higher this morning after geopolitical and trade risks ramped up over the weekend, and OPEC Plus hiked production by less than some feared. Now, for more, let's bring in Will Kennedy, our senior executive editor for energy and commodities. So, Will, there's a bit of a mismatch between what the market was expecting and what they actually ended up getting.
Well, they got more oil, 411,000 barrels a day, which was the scenario that people had been talking about mainly in the run-up to the meeting. On Friday, there was clearly a discussion or a suggestion that Saudi might try and go even faster than that. No. Didn't happen. So I think the price action today partly reflects the fact that there was this possibility that there would be an even bigger supply increase, and that didn't happen. So there's a little bit of relief there.
So when you look at prices, how are they faring in the face of this continued tariff uncertainty?
Yeah, prices are holding up relatively well. We're getting all this oil back into the market, and yes, we're down in the low 60s, but they're held up there. And I think underlying this, especially among some OPEC members, is a feeling that the fundamentals of the market aren't too bad. Lower prices have helped presumably shore up demand. We've seen a strong start to the driving season in the United States. We've heard some optimism there about how much people are traveling. So yes, prices are lower, but the fundamentals of the market are probably quite strong, and there are other places where supply may not be as rapidly expanding, notably the shale patch in the US. So we're lower, but I think the Saudis will think that the fundamentals aren't all that bad.
Yeah, I mean, the Saudis really are kingpin, right, of OPEC. They're kind of deciding everything. What do we know they want?
I think they want several things. I think they have probably three broad strategic reasons for pursuing the policy that they're pursuing, which is, of course, different to the policy that they had been pursuing, which was to rein in production and keep prices high. I think those reasons are to enforce discipline within OPEC+, some frustration with overproduction from countries like Kazakhstan and Iraq. I think it is to grab back market share from shale, among other places. And I think the geopolitical context is important, and clearly Donald Trump, a key Saudi ally, wants lower oil prices. And you put those three things together and you sort of got a mixture of strategic reasons which mean that Saudi Arabia decided that it was going to pursue a different strategy.
Yeah, what happens next? Do they redecide depending on where the price of oil ends up in September, or could it be sooner?
Well, we know that the Saudi oil minister, Prince Abdulaziz, he likes to be agile, he likes to keep people guessing, he likes to manage in the short term. I think that the expectation is that we will get at least one more of these 400,000 barrel day increases. Beyond that, it's hard to see. Some people say it's slightly weaker fundamentals going in towards the end of the year, so I think they'll be very, very alive to what the demand and supply fundamentals look like month by month.
Well, thank you so much. Will Kennedy, they're Senior Executive Editor for Energy and Commodities. Now, BYD shares have continued to plunge despite monthly sales climbing to the highest level this year. Now, this comes as the electric vehicle manufacturers' steep discounts draw scrutiny from Beijing. Bloomberg's Katrina Nicholas is here with the latest. Katrina, so why doesn't the Chinese... Good morning, first of all. Why doesn't the Chinese government like BYD's sales strategy?
Well, I think it's important to note that Beijing hasn't explicitly come out and named any car makers here, although a lot of commentators have sort of assumed that BYD is the company they're talking about. And they came out over the weekend in the People's Daily, which is essentially the mouthpiece of the Chinese Communist Party, criticizing this sort of rat race that is now taking shape in China's EV market. Price war has been a feature of this market since about early 2023. We've seen car maker after car maker sort of slash their prices continuously, and it's sort of resulted in this downward spiral, and it's really eating into automakers' margins. Good news for consumers, although with the lackluster economic environment in China at the moment, it doesn't seem to be driving perhaps as many people into showrooms as the automakers would like. And one of the concerns that the government has is that it was saying, these sort of lower priced and lower quality products could seriously damage the international reputation of made in China vehicles. Just as a time, I think it would be fair to say that made in China vehicles are actually starting to come onto their own into the world stage. Certainly in BYD's case, we're seeing them exporting to a number of markets around the world, particularly into Europe, into Southeast Asia, and their cars are being, reviewed as being very good quality, packed with very high-tech technology, and certainly also value for money.
And so is what we're seeing now just a BYD issue, or is it more systemic across China?
So BYD has not been the only car maker cutting prices. BYD late last month sort of kicked off another round. They cut prices by as much as 34% across various models. And that, of course, saw other automakers follow suit. Geely, Leapmotor, they all announced price cuts of their own. I think for BYD's case, it's interesting to see what effect that's having on its sales. We had sales numbers for May for BYD out yesterday. And even though May was actually the best month for BYD so far this year in terms of sales volumes, month on month, it was only, year on year rather, it was only up 15%. Now that's the slowest growth for BYD since about August 2020, barring one particular month in February over the Lunar Year. So you are seeing BYD's growth slowing. Now BYD has set a target of about 5.5 million vehicles in 2025. Currently, 1st of June, 2nd of June, we're at a run rate of 1.76 million. Now, if you extrapolate that out, that only gets to about 4.2 million. So it's looking quite short for BYD. And I think there are some concerns about, whether this car-making juggernaut can actually meet its full-year targets. Important to note, though, fourth quarter sales for all automakers in China are usually pretty strong, as car makers tend to sort of, get people in the showrooms towards the end of the year.
So interesting, Katrina. Thanks so much. Katrina Nicholas there with the very latest on BYD and Greater China. Up next, it's Bloomberg Brief, and this is Bloomberg.
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
What would it mean for India to host the Olympics?
Haslinda, I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. I think once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage, and 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
Countries which have hosted the Olympics have always grappled with the issue of infrastructure, for instance. Building it is one thing, maintaining it is another. How can India do it differently if it were to host the Olympics?
So I think we're talking about innovation and sustainability. And I think the same holds for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? So I think the move has to be a sustainable move.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It is 5 a.m. in New York City. Good morning. It's not Bloomberg Surveillance. It's Bloomberg Brief. A little trick for you this morning. I'm Danny Berger. Here's what you need to know this morning. The truce falls apart. China and the U.S. accuse each other of violating their trade deal. A historic shift, no longer defending prices. OPEC hikes oil output for a third consecutive month. And Delta and IAG says that travel demand is beginning to recover. We're live from the IATA annual general meeting in New Delhi. Well, we are off the back of the best month for stocks since November of 2023. Can we hold on to the gains? Lori Calvasina over at RBC has upgraded her year-end target, saying sentiment is better, but it is still choppy. And the chop we are getting this morning down by about 0.5% for both the S&P and NASDAQ 100 futures. Also better week last week for the bond market. We went lower by about 11 basis points for your 10-year yield. Some of that comes back this morning. We're higher by 4 basis points, 2 for the front end, currently standing at 4.44%. Those are your overall markets. Let's get you some stocks to watch. With that is Valerie Teitel. Hey, Val.
Hey, Val, good morning. It's all about those Trump tariffs that he announced on Friday to double the import tax on steel and aluminum. Take a look at these steel stocks behind me. Cleveland Cliffs up 27%. Nucor up nearly 13%. They're the biggest producer of steel in the U.S. Let's flip on and check on also the aluminum makers. The biggest primary maker of aluminum in the U.S., Century Aluminum, also up some 13% in the pre-market. Lastly, Danny, let's end on pharma. Moderna given approval by the FDA for their new lower dose COVID shot. Those shares are rising some 5% pre-market.
Valerie, really appreciate it. Valerie Teitel there. We'll catch up with you later in the hour. Also this hour, in just moments, Sharon Bell of Goldman Sachs will join us to give her gauge on earnings. Terry Wiseman of Macquarie Group will also give us his call on the dollar. And we'll hear from former U.S. Education Secretary John B. King Jr. on President Trump's attack on elite American universities. Now, earnings season came with a lot of unevenness from companies, a lot of warnings when it comes to dealing with tariffs. But within that, Sharon Bell of Goldman Sachs writes, quote, earnings call sentiment around the theme of CapEx sharply decreased for European companies during the last quarter. The decrease was less pronounced for U.S. companies. I'm pleased to say that Sharon joins us now. Good morning, Sharon. Really great to see you. I wonder if that very fact within itself, that CapEx was more robust around U.S. companies, argues for American stocks catching up to European stocks, which are still outperforming for the year.
Absolutely. I mean, European stocks have done extremely well this year. And I think that it is related to people wanting to diversify outside of the dollar, outside of the US market, because versus history, it looks relatively expensive. We're not arguing that Europe will continue to outperform the US from here, and certainly there are some signs, like you saw from that CapEx sentiment indicator, that there's some weakness and uncertainty for European companies. But equally, we also see it impacting US companies as well. Tariff uncertainties obviously hit the dollar and hit US expectations as well.
I wonder if all of that CapEx, though, Sharon, does it just come down to big tech? There's still such an appetite from the hyperscalers to be spending on things like data centers, which is not as present in Europe. If you don't have big tech, are we getting back into that environment that's the ingredient you need to outperform?
Well, I don't know that always spending more money is going to necessarily lead to outperformance, but I do agree the big hyperscalers, we've had recent announcements of yet more investment spend on AI, on data centers, on infrastructure, etc., from the big tech companies. So yes, I do think that they are increasing investment, and yes, I totally agree that you don't have that scale, let's say, in Europe that you do in the US. But it's also a worry for US big tech as well, that they have doubled their amount of investment this year compared to what they were doing a couple of years ago, and they've got to make a return on that investment, and competition is rising as well. So I think it's a double-edged sword at the moment.
Sharon, in some ways it's a comfort that we're talking about this again. It's a market narrative that had been present for the past couple years. This year seemed like it had been, and really still has been, dominated by trade headlines. But you can get pretty burnt out by chasing every headline. How do you signal what is noise and what is signal from various political movements?
I completely agree on being burnt out by all the trade flipping and flopping. The headlines move differently every day. But, what they do create is uncertainty. And until there's clarity, and I'm particularly sitting in Europe looking at European companies, there is lots of risks still. The EU and the US haven't signed a trade deal. The sort of pausing of tariffs ends on July the 9th. Trump has talked about a 50% tariff on EU exports to the US. That would be very big for Europe. We reckon it would take about 1.5% off of European GDP growth. That would be sizable. Anyway, this all creates uncertainty. I think it's unlikely you're going to see that type of 50% tariff, but of course the risks go up, don't they, when it's being discussed? And that uncertainty generates sort of lack of investment, lack of job growth, etc. And I think that's true on both sides of the Atlantic, by the way, not just in Europe.
So this gets back to where we originally started our discussion, this idea of European outperformance. Sharon, are we going to enter an environment where the economy starts to dictate where European equities go? Just how pressed and how much of an issue do you think some of these tariffs will be, considering it does seem like it's Europe and China that's really been the concentration of Trump's ire?
Yeah, look, I think that there are some headwinds to European earnings, and we have zero European earnings growth this year as sort of top-down macro view of European earnings. And I'd say the headwinds are the weakness in oil prices, which may be good for European consumers, but it's bad for the big oil energy stocks. The stronger European currencies. Clearly, European companies are global, so when they have dollar earnings, they translate those back into euro or sterling. They will see a hit there. And then the weaker growth caused by this uncertainty. But on the other hand, if you look out beyond this year, then we've got some positives too. I think you will see the benefit of falling energy prices for the consumer in Europe. Also, you will start to see some of this spending come through. Germany, more fiscal spend across the whole of Europe, more defence spend, etc. So a bit more of fiscal spending there. And also we expect the ECB to cut rates this week, do at least another cut, that policy stimulus as well. So I think this year, yes, weakness related to the uncertainty. Next year, a little bit better growth.
Even dollar weakness, Sharon, in some ways, is that beneficial for European equities? Not because of the earnings, but because of the flows. For example, even though U.S. stocks are back into the green this year, if you're an investor sitting where you are, Sharon, in the UK, you're looking at losses because of the dollar weakness. Does that argue for more flows to stay locally?
I think you've absolutely hit the nail on the head here. Yes, if you look back at the last decade or so, the strength of the US stock market coincided with a stronger dollar. And even though you had weaker euro and weaker sterling over that period, it didn't protect European stocks. People wanted US assets, partly because you had the Mag 7, you had the tech companies, you had all the growth related to that, but partly because of the stronger dollar as well. Now people are more concerned about the dollar. Trade risks have been a depressing factor on the dollar. You're starting to see, particularly European investors, particularly domestic investors, want to invest more back home. And then on top of that, you've got those further out things I talked about, fiscal spend, defense spend. You're also seeing a little bit of deregulations moves in Europe too. The Savings and Investment Union helping to get more capital flows into Europe domestically as well. So there are a few things, I think, that are encouraging European investors, in a way, back to Europe.
Sharon, I just want to end with some of the most recent data we've gotten, specifically when it comes to shipping volumes. It's still incredibly depressed, regardless of where you look, regardless of whether it's coming from China or from the EU to the US. Is that a bad signal for where corporate earnings go from here after what we've already heard this earnings season?
Yeah, look, I think this year I said we were going to get zero earnings growth for European companies. I think that earnings and GDP will generally be quite weak this year, both in Europe and in the US. And the reason for that is the global trade weakness. You see this in the shipping data. You see this in the soft survey data, less so in the hard economic data yet, but I think you will start to see that from the second quarter data. The third quarter data will be a little bit weaker. And I think all this is related to the uncertainty.
Hey, Sharon, also, just thinking about European equities, so much of the growth case for a lot of European companies had been expansion globally and expansion into the U.S. Do we need to start rethinking that? Do we need to start rethinking European business models when it comes to how they achieve high growth?
It's a great question. I think, roughly speaking, if you look at the Stock 600, the broad index in Europe, about half of its exposures to Europe, the other half is international. So it's a very international index. And then of that international half, it's kind of 50% US and 50% the rest of the world. So European companies are generally very global, but they have, you're absolutely right, expanded into the US. For all those trends that I mentioned before, better economic growth in the US, perhaps more opportunity in terms of technology, and also the stronger dollar as well. And some of those things are reversing. So yeah, we're definitely getting more interest in domestic European companies, domestic quality companies. Last week, our worst performing slice or basket in the market was our US exposure European basket. So yes, you are seeing a little bit of that movement now.
Sharon, so wonderful to catch up with you on this Monday. Enjoy the rest of your week. Sharon Bell of Goldman Sachs. Let's now get you some other top stories that are trending on the terminal this morning. As the debt ceiling deadline nears, U.S. Treasury Secretary Scott Bessent said the U.S. would never default. The secretary spoke to CBS on Sunday.
Well, first of all, Margaret, I will say the United States of America is never going to default. That is never going to happen. That we are on the warning track and we will never hit the wall.
Elsewhere, Sanofi agreed to buy Blueprint Medicines in a deal worth at least $9.1 billion. The French drug maker is looking to grow its rare immunology disease portfolio. It will pay $129 per share for Blueprint. And Stanley Fischer, a professor and practitioner of macroeconomics, as well as former vice chair of the Fed, died on Saturday. Fischer served as a governor of the Bank of Israel in a career that also spanned the IMF, World Bank, and MIT. The roster of students he taught was large and influential. It included former Fed chair Ben Bernanke, former ECB president Mario Draghi, and Bank of Japan governor Kazuo Ueda, among many others.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
They violated a big part of the agreement we made. You know, if you read that whole statement, I was very nice to them. I helped them because they were in trouble with the stoppage of a massive amount of business. But I'm sure that I'll speak to President Xi and hopefully we'll work that out. But yeah, it's a violation of the agreement.
The Chinese Ministry of Commerce now rebuking President Trump's claim, accusing the U.S. of violating the trade agreement, writing that it resolutely rejects the U.S. accusation, going on to say, quote, if the U.S. insists on its own way and continues to damage China's interests, China will continue to take resolute and forceful measures to safeguard its legitimate rights and interests. Joining us now is Bloomberg's Brendan Murray. Brendan, it was only on May 12th, 3 weeks ago, that we had an agreement and a perceived cooling of tensions between the U.S. and China. What's changed?
Well, it looks like the temperature is going back up in the other direction. It's you have President Trump's statement from Friday saying no more Mr. Nice Guy, and then the Chinese response today saying, you know, you're not protecting our interests, and this goes beyond the trade world. This would include the U.S. cracking down on Chinese student visas and some other issues that, you know, China would find offensive, and so it looks like the sides are going further and further apart to talks than further together. So President Trump, his aides were on the Sunday shows yesterday saying, oh, there are talks coming soon between the two leaders. Well, they've been saying that for a couple of weeks now, and we've yet to see any sign that that's going to happen. And the tensions that we're seeing increasing between the statements that the two governments are trading back and forth would suggest that that's going to be tough to pull together within days. So it could be you know, weeks before we see something like that.
And as they tried to get a deal together, there's a lot of work to be done with the U.S. and China, the U.S. and EU, the U.S. and basically every other nation. Amid that, Brendan, we also had the president announcing an increase of tariffs of 50% on steel and aluminum. How does that change things?
Well, this is the president acting just a couple days after that court ruled this other authority that he used for his universal tariffs basically illegal. Now, that's caught in legal limbo for the time being, but in the interim, the president has this other authority, this 232 authority that he's used for steel, that he's saying, look, I may have temporarily lost this other authority, or it's still in effect, but the courts are going to decide it. But here I have a pretty ironclad, legally speaking, tariff in steel that I'm going to go ahead and raise. And that's going to raise a lot of questions for countries that export steel, from South Korea to the European Union to Japan, which are involved in bilateral talks with Washington themselves. So it's going to complicate an already really complicated picture.
Yeah, that's for certain. Japan itself already saying that they don't see a way through to a deal unless those tariffs go away. Brendan, thank you so much for joining this morning. We really appreciate it. Bloomberg's Brendan Murray on the latest, what appears to be a breakdown between the U.S. and China after tensions had cooled. Reporting from both the Journal and Bloomberg suggesting it has to do with China slow walking its rare earth exports to the U.S. Now, coming up, we'll talk about travel. Delta saying that they see demand ticking back up. That follows warnings from the company earlier this year. We're going to have more on aviation executives from the IATA annual general meeting in New Delhi. All of that's coming up next on your Bloomberg Brief.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere. And I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. Earnings season is here.
Earnings, the hot topic of conversation. It's going to be a lot of fireworks.
Pretty astonishing moment in time in the earnings context.
Bloomberg is first to break the numbers.
Goldman Sachs, JP Morgan, Morgan Stanley.
Booking, Airbnb.
Meta, Microsoft, Qualcomm.
There's a lot to talk about here.
With the smartest insights.
We're not seeing dramatic weakness.
It has been an incredible period of time from a trading perspective.
We feel really good about the market share trajectory.
Continuing coverage on Bloomberg. Context changes everything.
It's your Bloomberg Brief. I'm Danny Berger in New York. Let's get you some front page news and see what's making headlines around the major papers this morning. The New York Times leading with a large-scale Ukrainian attack targeting air bases deep in Russia. The Defense Ministry said that drones attacked airfields in 5 regions, stretching across 5 time zones from Siberia to Russia's western border. Russia and Ukraine are set to restart talks after the strikes. And the Washington Post covering a tragedy and the FBI's investigation into an attack on a Jewish gathering in Colorado. 8 people were injured after a man threw an incendiary device at a pedestrian mall. The attack was on people calling for the release of Israel hostages in Gaza. And the Financial Times reporting on the nationalist candidate winning a knife-edge presidential election in Poland over the weekend. The victory deals a heavy blow for Prime Minister Donald Tusk's reform agenda. Now, the IATA annual meeting and the World Transport Summit are underway in New Delhi, and we heard from some of the top executives in the airline industry.
There's no question in the short term with what we've seen coming out of Washington and the political challenges of the trade negotiations. It's choppy at the moment.
I think some of these events that we're seeing at the moment are short-term in nature.
Year over year, though, demand hasn't fallen. Demand's pretty flat to...
Demand for aviation, demand for flying remains strong, and that will continue.
Joining us now is Bloomberg's Guy Johnson, who is live at the IATA annual general meeting in New Delhi. Guy, great to see you. Some really fantastic and high-profile conversations you've had. What has been your read on sentiment in this industry?
So the read is that sentiment got dinged up pretty badly around the time when we saw the trade war being launched. Danny, there was clearly a period of uncertainty. That has had an impact on both business travelers and also you've seen leisure travelers being affected by that as well. There's a sense that maybe some of that is beginning to come back a little bit. Some of that is starting to translate into a bit more stability in terms of the demand picture. Ed Bastian was talking about that, the CEO of Delta. Remember that back in April, Delta withdrew guidance. He's now confident that we can probably reissue some guidance next time round when they issue financial results. Other airlines are saying a similar sort of thing. You've heard it from IAG. Air France is kind of talking about stability. So IAG, the owner of British Airways, you're starting to see other airlines talking about it as well. I just spoke to Shai Weiss, the CEO of Virgin Atlantic. A sense maybe that stability is coming back a little bit, but there's a real sense of fragility. Nobody's quite sure what is going to happen next. There's also a factor of kind of the idea that fuel is to a certain extent allowing them to compensate for some of the weakness that they have seen in demand. They're able to lower prices a little bit because of the lower oil price, so that's kind of offsetting things as well. But they all know that there's going to be a longer lasting effect. They're all hearing from the big manufacturers that maybe price rises are coming. The equipment is going to get more expensive. They're already seeing it in spare parts. So there's an awful lot going on at the moment, but I think they're all just happy to see, Danny, a little bit of stability coming back into the demand picture.
Well, to that last point, Guy, you spoke with Larry Culp of GE, who said that they might have to pass along some of their costs. Just how challenged is profitability going to be for the airline industry with tariffs on deck?
Yeah, I think there is a recognition that that's already the reality that's beginning to start. Remember that you've already got tariffs in place effectively. Larry Culp builds jet engines. There are thousands and thousands of parts that go into those jet engines. Some of those parts come from around the world, so they're being affected. That's impacting his costs. He's having to, at some point, start to pass those along. It kind of starts, Danny, in the spare parts business, and then it kind of works its way from there. So if you're ordering spare parts, you're already maybe starting to see some of those costs coming through. So yeah, I think there is going to be an inflationary impact from this. Larry Culp's already talking about the impact of that coming through. He says he's lobbying Washington very hard at the moment. And remember, we saw him a few days back in the Middle East, sitting side by side with the president. He's lobbying very hard to try and get a carve-out for aviation. Aviation has prospered globally. It's become this global industry. The U.S. has benefited from that as a result of the fact that we haven't seen tariffs being applied to aerospace equipment. He says that is what is needed. It's not the reality right now, but he certainly says, Larry Culp says, that he's lobbying very, very hard the authorities in Washington to try and get that to be the new reality. But at the moment, that's not what we're looking at. So we'll wait and see exactly how that feeds through. It probably, at the moment, looks like it's going to be an inflationary input into the aviation sector, which will ultimately probably be borne by consumers and higher ticket prices, Danny.
Guys, such fantastic coverage. We're looking forward to continuing to follow along. That is Guy Johnson in New Delhi. Coming up, Terry Wiseman of Macquarie staying downbeat on the dollar. He'll join us next on your Bloomberg Brief.
another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know. The truce falls apart. China and the U.S. accuse each other of violating their trade deals. A historic shift, no longer defending prices. OPEC hikes oil output for a third consecutive month. And don't miss our exclusive interview with former U.S. Education Secretary John B. King Jr. on the latest funding freeze in higher education. Well, we are back off of the best month for U.S. equities since November of 2023. We're now higher on the year by 0.5%, but we lose steam this morning, down about 0.5% for the S&P, a little bit more for your NASDAQ 100 futures. Lori Calvasino over at RBC raising her price target for the year. Slightly better, she says, sentiment, but still choppy. The bond market, that's also under pressure this morning after rallying by about 11 basis points lower on the 10-year yield last week. We're up by 4 basis points for your 2-year yield. It's about 1 basis point. We have non-farm payrolls. That's the event to pay attention to on Friday. Those are your overall markets. Let's get some stocks to watch here. With that is Valerie Teitel. Hey, Val.
Hey, good morning, Danny. Let's start in the metals space because we have those steel and aluminum stocks just flying off the shelves in pre-market after Trump plans to double the tariff to 50% starting Wednesday. Cleveland-Cliffs up 27%. Nucor, this is the biggest U.S. manufacturer of steel, up 13%. Century Aluminum, that's the biggest primary manufacturer of aluminum in the U.S., up some near 14% as well. It's not all good news, though, for those out there on these higher tariffs. The one stock to the downside is Stellantis. They're down 2.4% as they have many of their factories in the U.S. and they depend on imported steel. I want to end on pharma here, Danny. Moderna has just gotten recent approval for its lower dose COVID shot from the FDA. We're seeing those shares of Moderna rise near 5% in the pre-market.
Valerie, appreciate it very much. Valerie Teitel. Now, the dollar continuing to weaken this morning, down about 0.5% for the Bloomberg dollar spot. Terry Wiseman of Macquarie Group weighing in on the greenback, writing, quote, "We don't expect that the international system will dump the U.S. dollar, but we do expect that advocacy for the diminishment of use of the U.S. dollar will grow, supported by other slow and steady policy measures to bolster other core currencies." Joining us now is Terry Wiseman, FX and rate strategist at Macquarie Group. Terry, really wonderful to see you this morning.
Good morning.
So is it your estimation then that this is not a right sizing of overexposure to American assets we had the start of the year, but rather this is a structural shift that's going on?
It's both. The dollar is overvalued and foreign investors are overweight U.S. assets. Now, that's a reflection of the fact that the stock market has rallied in the U.S. more than it has in foreign markets. It's also a reflection of the fact that the dollar has been so strong for 12 years. I mean, you're talking about a cumulative appreciation of the dollar by 40% in real terms since since 2012. It's been an unprecedented run for the dollar, and anyone who's been invested in dollar assets that has not been hedged has taken advantage of that run in the dollar, especially if they're sitting abroad. So valuation is part of the story, but valuation is only half of the story. If it weren't for the premise that the U.S. is potentially looking to disengage from the rest of the world, that it's doing that through trade policy, that the whole structure of U.S. engagement with the rest of the world, especially in regard to national security and guaranteeing free trade, if that weren't at risk, I would say valuation might not take us towards a lower dollar. But I do think that between high valuations and the weakening of the brand value of the dollar, that the need for diversification on the part of foreign investors will continue, and that will drive the dollar towards a more normal level, something more commensurate where it's been over the last few decades as opposed to the last 12 years.
Well, if you were to just use the normal playbook, you could argue it is for higher dollar. You have a relatively hawkish FOMC. You have the ECB and the Bank of Canada likely to cut rates this week. The data has been holding up. Does any of that cut through?
It matters. Central banks matter, and relative interest rates matter. But I would urge here to consider the fact that central banks these days are not being proactive. They're not the drivers of economic policy. They're actually the followers. Economic policy is being driven by diplomats, especially economic policy diplomats. The whole issue with tariffs and trade is really not something under the purview of the central banks. They are being reactive to what the headlines they're reading, just like the market is. And I think from that perspective, their role is diminished, and what they're doing on a relative basis, the Fed being somewhat hawkish, foreign central banks being somewhat dovish, is a lot less important than it used to be as a driver of FX, and you've seen that effectively in the last few weeks, right? The Fed has remained hawkish, not just in the last few days, but of course it's been that way all year. The ECB and the BOE have been pointing to lower rates all year, and yet we have seen the dollar appreciate relative to both the euro and pound sterling.
So if it is politics driving the economy, how do you distinguish signal between noise? Because it is, we're discussing this in the break, it's headline fatigue. It's constant headline after headline. How do you separate what is meaningful, what gets walked back, and what has a lasting impact on the dollar, on bonds, on risk assets?
I think what's important here is that taking a long-term view is what's important, right? It's very difficult to actually try to trade these headlines, especially insofar as we don't know how Washington will act. Everything that they've done so far has been aggressive, it's been abrupt, it's been somewhat pugnacious, and that, of course, does cause headline fatigue. But what we stress to clients is they should take into account not the next few weeks of headlines, but the next few years of direction. And if you approach it that way, and you look at long-term valuation from a long-term perspective and what the dollar has done over the last 12 years, you have to come to the conclusion that there's actually very little risk in taking the view that the dollar will decline from here because it is so rich relative to history.
Well, beyond just the dollar declining, what does it do to overall portfolios when you usually have the dollar in there as a stabilizing factor? What changes if that changes?
Well, it's interesting you bring that up because not only are we seeing weakness in the dollar in the last few weeks, but we're also seeing a change in the dollar's structural relationship to risk. Yeah. It used to be the fact that the dollar would act as a safe haven. So then when global stocks sold off, the dollar would rally. But we've seen a few weeks, especially since Liberation Day, since April 2nd, where it's been the opposite relationship, right? We've seen stock markets sell off, and the dollar sell off at the same time, and vice versa. Stock markets could be strong and the dollar could be strong. That's a very different relationship than we have become accustomed to, and I think it reflects the way the faltering, the fading, the dissipation of the brand value of the dollar. The dollar is no longer seen as a safe haven currency, in part because most of the news that's creating risk is coming from the U.S. and not abroad. So it makes sense that people would read these headlines, read them to be adverse for global trade and global growth, and at the same time sell the dollar.
Well, in that quote I read from you to start out, part of the other thing driving it wasn't just the U.S., but other policymakers trying to put forth their currencies as something that can act maybe as that haven. Christine Lagarde has been very explicit in her desire for that to be the case for the euro. But you look at elections in Poland, for example, where you have a Eurosceptic coming into the office. Is that a really realistic alternative or something that can take some of the space that the dollar held?
The euro can certainly take some of the space that the dollar held. It's not just because we're going to see more fiscal spending and fiscal reform out of Germany, and we could see a growth boost in Europe as a result of these policies, but also because we could see joint bond issuance, right? There's going to be a summit of European leaders, I think in The Hague in the next few days, and they will talk about things that will try to bring some coherence to the euro, in effect, through the capital markets. Joint bond issuance is one of those things. Obviously, having a Euro-wide consistent bank regulation is another one of those things with deposit insurance. All of the things that the Europeans have been talking about for several years now may finally come to the fore over the next couple of years, and I think that will make or put, let's say, the euro on a more equal footing with the dollar as a place for investors to put fixed income assets into.
Terry, it is always a masterclass, and I do just want to plug, if you want to get more of Terry Wiseman, he will be joining Bloomberg Surveillance Radio at 7 a.m., so stay tuned for that as well. Terry, thank you so much for joining.
Thank you, Dan.
We always appreciate
Thanks for the pitch.
Always be pitching. Terry Wiseman of Macquarie Group. All right, let's get you some other stories that are trending on the terminal this morning. Now, as the debt ceiling deadline nears, U.S. Treasury Secretary Scott Bessent said the U.S. would never default. The secretary spoke to CBS yesterday.
Well, first of all, Margaret, I will say the United States of America is never going to default. That is never going to happen. That we are on the warning track and we will never hit the wall.
And Sanofi has agreed to buy Blueprint Medicines in a deal worth at least $9.1 billion. The French drug maker is looking to grow its rare immunology disease portfolio. Sanofi will pay $129 per share for Blueprint. And Stanley Fischer, a professor and practitioner of macroeconomics, as well as former vice chair of the Fed, died on Saturday. Fischer served as the governor of the Bank of Israel in a career that also spanned the IMF, World Bank, and MIT. The roster of students he taught included former Fed chair Ben Bernanke, former ECB president Mario Draghi, and Bank of Japan governor Kazuo Ueda, among many others, a man that has left a lasting impact.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
They violated a big part of the agreement we made. You know, if you read that whole statement, I was very nice to them. I helped them because they were in trouble with the stoppage of a massive amount of business. But I'm sure that I'll speak to President Xi and hopefully we'll work that out. But yeah, that's a violation of the agreement.
The Chinese Commerce Ministry has hit back on those claims from President Trump, now accusing the U.S. of violating their trade agreement. The ministry wrote that it resolutely rejects the U.S.'s accusations, saying, quote, if the U.S. insists on its own way and continues to damage China's interests, China will continue to take resolute and forceful measures to safeguard its legitimate rights and interests. Back with us is Bloomberg's Brendan Murray. Brendan, it was only 3 weeks ago that we had an agreement coming out of Geneva. What's changed?
Yeah, I mean, it doesn't sound like we're very close to the two leaders getting together at all, despite what we hear from the White House, that something like a phone call between President Trump and Xi is imminent, with something that's happened within days. We heard from China, the Commerce Ministry today, saying that this is an unacceptable approach to dealing with us, and this agreement, this 90-day extension into mid-August is something that they need to get to the table to start talking, and they're far from that, it would appear. So it seems that there are a number of issues that China has, ranging from the crackdown on student visas to some barriers to Chinese tech exports that Washington is doing, and the U.S. is saying China isn't upholding its end of the deal too. So it looks like things are going in reverse rather than forward at the moment.
Brendan, there's also been some reporting, both from our team and from the Journal, that some of this has to do with slow walking of approval of rare earth metals. How much of this is about right-sizing supply chains for the U.S. and making sure that we don't have COVID-style issues in terms of supply chains breaking down for critical industries?
Yeah, absolutely. I mean, this is something that the U.S. Trade Representative Jamieson Greer mentioned last week, that these are items that American businesses need to build everything from electric vehicles to high-tech medical products, and these are things that China controls largely the supply of. And this was part of the agreement that they reached in Geneva 3 weeks ago, that China isn't living up to its end of the bargain, and China is saying, well, you're not living up to your end of the bargain either. So it sounds like we're basically at loggerheads again. Again, we have a couple of months before the deadline, but these are complicated talks, and once they get underway, and they can't even really agree on the tone of the talks or what specifically they could discuss. So it seems that this is going to drag on for weeks, if not months.
Brendan, thank you so much for your excellent reporting this morning. That is Bloomberg's Brendan Murray. Now to oil, where prices have been climbing up 3.5% this morning for NYMEX crude. OPEC's increased production over the weekend for a third time, with geopolitical concerns still growing over Ukraine and Iran. Joining us now is Bloomberg's Will Kennedy. Will, if you just take the decision at face value, the fact that they've increased output for a third consecutive time, you'd figure that oil prices are lower. Let's just start with the price action. What do you make of it?
Well, I think the increase that they came up with, 411,000 barrels a day, had been well flagged and priced into the market. There was some discussion that there might have been a bigger increase, and that didn't happen. So I think there's some relief there in the rally this morning. The other thing that came out over the weekend was some difference of opinion between the two biggest members of the OPEC Plus coalition, Saudi Arabia and Russia, with Russia arguing for a possible pause in production increases while the market is assessed. I think that the market will take that dissonance between the two leading members as perhaps bullish, and a signal that increases may not come so quickly from here on in. We will see, but you put those things together, and I think that's why you get the bump this morning.
Is it a shift in strategy, Will? Yes, it was less of an output hike than we expected, but it still is a coalition that usually we are used to them defending prices, not doing something that could potentially damage them. Is this a different strategy from here on out?
Yeah, I mean, clearly we've seen a big shift in strategy in recent months, from the point at which the Saudis surprised the market with that initial 411,000 barrel increase, and we've had two more of those subsequently. So production is rising, prices are lower than they were. Saudi strategy and Saudi tends to set the tone among OPEC Plus, has clearly shifted, and I think there are three different things driving that. Frustration that some members of OPEC Plus, including Kazakhstan and Iraq, weren't meeting their commitments and free riding on Saudi's discipline, a desire to grab back market share. By reining in production, they'd given up market share to non-OPEC producers like the shale patch in the US, and there's the geopolitical background. And while we don't know that this is being driven by Donald Trump, clearly Donald Trump has always said that he wants lower prices. The relationship matters to the Saudis, so there's an opportunity to win kudos with the White House. You put those three things together, and I think you start to get a strategic rationale for this policy shift from Saudi Arabia.
Well, excellent coverage. Thank you so much. Bloomberg's Will Kennedy. Now, back here in the U.S., graduation season is in full swing. But amid that, there are concerns over federal funding freezes at higher education that's clouding so many institutions as they wrap up the semester. I spoke with the Chancellor of the State University of New York and former Secretary of Education, John B. King Jr. Take a listen.
It's shocking the degree to which the Trump administration is really trying to undermine higher education, which is one of the country's great assets. Our higher education institutions are the envy of the world. The best talent in the world wants to come here. Our higher ed institutions have driven our innovation economy, great advancements in healthcare. And so for those institutions to be attacked by the administration is deeply troubling.
Does it damage brand America as a whole?
I think so. Look, this effort to undermine international students' ability to come to American universities, very dangerous. So what we're seeing is students choosing universities in other countries. We're losing out on that talent. And increasingly, we're seeing faculty members getting recruited by institutions in Canada, in Europe, who are saying, we know that your federal government is attacking investments in research. We want to invest in research. We want to lead in innovation.
Well, you have seen some court rulings, for example, Harvard getting kind of a pause and having to not allow foreign students to come in. Even with these pauses, even if we don't see the policy come in, are there scars that are left over on the university system?
Absolutely. Look, it's very disruptive, and it's frightening for students and families. I think as a country, we're going to see fewer international students next fall, even if the courts side with higher education, because families around the world will think to themselves, well, why am I going to send my child to the United States if the United States is not a welcoming environment?
What have you seen, just also in terms of finances? A lot has been made of that too. If you don't have foreign students, it gets more difficult to even run the colleges. Is that a real concern?
We're worried about that at SUNY, at the State University of New York. About 6% of our students are international students. So we're watching things very carefully. At the moment, we're expecting students to come, but we are worried that this attack on higher education is going to undermine that. We're also worried about research funding. We do about $700 million a year in federal research funding. This is funding for things like cancer research, Alzheimer's research, research around the treatment of 9/11 first responders, research into new technology like artificial intelligence, renewable energy. All of that is under attack, and we're worried we're going to lose those dollars that help drive economic development in New York State.
Can you help us understand, especially from your time as Education Secretary, what the threshold usually is to revoke federal funding from a school?
It's incredibly unusual. And if it ever happens, it's targeted to the specific activity that is under investigation. But what you have here is the administration arbitrarily taking funds from schools without even an investigation, without findings of wrongdoing. It's very disturbing, and that's why I think you're seeing the courts step up and reject these efforts by the administration.
Are you confident in the court system's ability to put checks and balances on that?
I'm hopeful about the courts, and I'm also hopeful about Congress. You know, the tradition in Congress is bipartisan support for higher education, for research funding, for financial aid for low-income students and middle-income students to be able to access higher education. So I'm hopeful that Congress will step up. We certainly are talking with members on both sides of the aisle in the New York delegation.
That was State University of New York Chancellor and former U.S. Education Secretary John B. King Jr. You can listen to the entirety of that interview on Bloomberg.com and on your terminals. Coming up, we'll get you set up for the trading week. It's a big one. Chair Powell's remarks and the jobs report will have your trading diary for you next on your Bloomberg Brief on this sunny morning in New York City.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne Ruhodern in Buenos Aires, Argentina, and this is Bloomberg.
You are watching Bloomberg Brief. I'm Danny Berger in New York. Now let's get you set up for your trading week. Kicking things off, manufacturing PMI, 9:45 and 10 a.m. Eastern. Chair Powell will also be speaking at 1 p.m. And then we're going to get an ECB rate decision that comes on Thursday. And we are going to be wrapping up the week. We're going to get the big report. That is your jobs on Friday. All right, let's get you some individual movers this morning. Cleveland-Cliffs. Now, that's one of the big winners. Steel stocks in general rallying after President Trump saying he would impose a 50% steel and aluminum tariff. That is a boost from 25%, so a big rally of 30%. Sanofi also announcing that it would be buying Blueprint Medicine. Sanofi, the French drug maker. That deal worth $9.1 billion. You can see those shares up 26.8%. Finally, Tesla, that is falling. Chinese EV makers, BYD in particular, really strong volume growth for the month of May, so that hurting Tesla back down 2%. All right, let's get you a look on the dollar as we head to the end of the hour, because it is weaker this morning, down about 0.5%. We were talking with Terry Wiseman of Macquarie earlier, who said it's both structural and a shift out of overexposure to U.S. assets. Morgan Stanley, for their part, sees a decline of 9% for the dollar through next year due to weakness from the U.S. economy, so a lot of bearishness surrounding the impact. All right, that is up for your Bloomberg Brief. Surveillance takes things from here. This is Bloomberg.
at Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The magnitude and the severity of the trade restrictions are in doubt.
Many companies are on pause. They're waiting to see what's going to happen.
One thing that we have seen has been a willingness by the administration to extend deadlines related to tariffs.
What can happen from a policy standpoint can change any minute.
Data, the administration, trade is so volatile, but at this point, I think that we've really seen the worst case.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance in a new week, a new month with a lot of the same problems. Trade tensions piling up between the U.S. and China yet again, with both sides accusing the other of violating recent agreements. Washington, D.C., meanwhile, shrugging off bond market worries despite Jamie Dimon's warning that the market will, quote, crack under the weight of the deficit, and Wall Street counting down to payrolls Friday at a time when traders have no idea what to do with data these days. Anne-Marie, I've got to say, Peter Scheer of Academy Securities summed it up for me over the weekend when he said, for me, sentiment surveys are on the cusp of shifting from confusing to irrelevant. Even the establishment data is not getting the kind of survey responses that usually warrant any kind of particular credibility or support.
Well, what does the data matter when the policy is still so uncertain? And what we hear from corporate America, from what we hear from the Fed, is that everything is on pause. Everyone is wait and see because they're waiting for policy certainty. And we begin today with more policy uncertainty. We thought we had this détente between Washington and Beijing, the world's two biggest economies, and yet we're back to square one. And there's a lot of flame throwing right now and rhetoric when actually the market was almost arguably set up for something more positive.
So let's talk about where we are. We had this idea of a 90-day pause, and then suddenly these recriminations start going on where both sides are saying the other violated. And now it's back to who's going to call who again between Xi Jinping and President Trump?
Exactly. And Kevin Hassett, the director of the National Economic Council, said yesterday on the Sunday shows that he was expecting a call this week between President Trump and President Xi. After Friday, this time on Friday, we got that Truth Social from the president talking about that China is not living up to what they agreed upon in Geneva. China has come back and said, actually, that's not true, and it's the United States that is creating issues when it comes to AI export controls on chips, revoking visas when it comes to Chinese students. So now there's a multitude of issues right now in this détente we saw out of Geneva.
How likely is it that we're going to get some sort of phone call between the leaders of two countries at a time where you're talking about visas getting revoked for Chinese students, you're talking about slow walking the rare earths export license from China, and you've got a lot of pretty volatile language coming out from both sides?
Well, here's the thing. I think before there is going to be a call, everyone's going to go in with their maximalist approach and hottest rhetoric. So potentially we could see a call today, and even the Treasury Secretary is also leaning on at some point there will be a call, but I'm sorry, not today, this week. But the Commerce Committee has Administration of China has come out with some pretty harsh words. So potentially Beijing is going to look at this and say, we're going to slow walk this, because something the United States has made really clear, they want those licenses when it comes to the critical minerals they need for the industrial supply chain.
Yeah, the language out of the Chinese Commerce Ministry, if the U.S. insists on going its own way and continues to undermine China's interests, China will continue to resolutely take forceful measures to safeguard its legitimate rights and interests. Meanwhile, we also have, of course, the budget discussions that are ongoing in Washington, D.C., with the Senate reconvening and possibly taking up the reconciliation bill. This is going to be quite a fight at a time where you have Wall Street officials, and yes, Jamie Dimon has been sending out this warning for quite a bit, saying this time is different, the deficit looks more concerning, and we will act quickly if we don't like what we see.
Exactly, but for years, Jamie Dimon has been saying Washington, D.C., the government has been spending like drunken sailors. And they are. And this bill, this tax and spending bill, they will spend. One thing the Treasury Secretary did push back on this weekend was the fact that the CBO does not take into consideration other things the Trump administration is considering when it comes to the extension of TCJA and some other priorities of the president, things like the tariff revenue they are bringing in, and also what this could mean for growth. But Jamie Dimon was talking about when it comes to the bond market breaking. Terry Haynes, we're going to speak about, actually says this helps the Trump administration. They could talk about more spending cuts because they could say, look, even Jamie Dimon is talking about how our deficits are ballooning and the bond market might crack.
Well, this is going to be something we'll be debating throughout the week. Meanwhile, we are seeing a little bit of softness coming off the biggest monthly gain in 18 months, the biggest May performance going back to 1990. Today, we're taking back just a bit of that, down about 0.6% on the S&P. You are seeing yields just marginally higher across the board. 10-year yields 4.44, and you could see crude popping. And this is something we're going to get to in a little bit on the heels of a number of attacks overnight between Ukraine and Russia ahead of talks today, supposedly taking place in Turkey. Coming up this hour, we've got Russ Kosterich of BlackRock as trade uncertainty weighs on stocks. Former Trump White House trade official Kate Kulukowicz with U.S.-China trade tensions back on the table, and Matt Hornbach of Morgan Stanley predicting yet more dollar weakness. We begin this hour with stocks lower as tariff concerns weigh on markets once more. Russ Kosterich of BlackRock writing, elevated valuations and the potential for further economic disruptions suggest a trading range rather than a quick sprint to new highs. Russ joins us now. Russ, I got to tell you, every single note that I read over the weekend said the exact same thing. It's going to be a trading range. It's going to be choppy. How are you trying to get an edge in this?
Well, good morning. I think there are a couple things. You know, again, it's probably no big surprise that people are seeing the challenges you're going to have to, putting new highs into the near term. But I do think we've learned a couple things in the last few months. One of which, the economy is still, as of now, fairly resilient. Second, while tariffs are going to impact prices in the near term, and we probably haven't felt the full effect yet, at least we're going into the situation with inflation coming down, getting closer to Fed's target, so that's a good thing. And finally, earnings were surprisingly good in Q1. So we are thinking about this as a range. One of the things we've been doing, which has worked very well the last few months, is using volatility as an asset class. Thinking about times in the market when you're close to what we would define as the upper end of the range, selling upside, using volatility to manage your downside. Because again, this is a very different market than we had in 23 and 24, where the market just sprinted 20, 25% a year. This year, we've had a ton of vol, and we're within spitting distance of where we started 2025.
Russ, to pick up on your point about the earnings, just that's one piece of the larger puzzle that you were just laying out there. It's something that a lot of people really honed in on. Julian Emanuel of Evercore ISI saying that this is one of the strongest earnings season blowouts since 1992. Lori Calvasina of RBC Capital this morning upgraded their expectation for year-end S&P 500 targets on the heels of some of this earnings performance. Does that make you more bullish on the margins for U.S. equities than you were before the earnings season began?
So certainly I feel better about it because I do think you came out of the earnings season with a couple of things. Not only were the overall earnings strong, one of the things you've noticed in this market is that really since around mid to late April, it's been the mega cap tech companies that have led. And a lot of the strength we saw in earnings season was because of those companies. And if you remember back to January, even before the tariff situation really became exacerbated, there was a lot of concern about would companies spend on AI? Did the DeepSeek news disrupt the narrative about spending on data centers and other types of CapEx? And so far, we have not seen that change. We've still seen a lot of very strong investment. by the hyperscalers, and that's given some people confidence in that AI trade. The caveat to all of that is a lot of companies maintain guidance in Q1 into the rest of the year, not so much out of a table-pounding sense of conviction, but more because they just don't know. There's so many uncertainties around policy, around tariffs, about the breadth of the tariffs, that it's still very hard to say with certainty how they're going to affect the economy going into the back half of the year.
What could be the new catalyst then for new highs? Is it going to be trade certainty?
I think certainty would definitely help. I think if we knew the extent, if we were able to plug some numbers into assumptions both about earnings and the broader economy, have a better feeling for what the downside is likely to be in terms of growth, yes, I think that's one catalyst. But the other one is still going to be some of these fundamental bottom-up themes that have really driven the market the last few years. And again, I turn back to some of the resilience we're seeing in mega cap tech, which is really what has helped the market move nearly 20% off of those lows we saw back in April.
But when it comes to mega cap tech, and I'm thinking of companies like NVIDIA at the moment, does it concern you that the Trump administration is really ratcheting up export controls? They want to de-risk when it comes to semiconductors and how much of those can get into China.
Well, just with the tariff situation, again, if we don't know all of the regulatory environment, that's going to create uncertainty, that's going to create a little less conviction. One thing that I think helps in this space, you had this massive correction in those names that actually began last year. It accelerated in January after the DeepSeek news. And of course, we saw the worst of it back in March and April. As a result, again, I don't think I would describe many of the names in this space as cheap. But relative to the broader market, we've seen a pretty significant repricing versus where we were at the peak last summer.
You say in your notes that you have a 3 to 4% position in gold as a hedge against policy uncertainty and also what's going on with the deficit. Is that enough at this moment?
It actually has worked very well. I mean, we've done a lot of analysis on what's the right position. Of course, there is no right answer, but I think that's probably around the right level. And one of the things that it has done, again, we've spoken about this in the past, if you look at gold day to day, it's not necessarily a perfect hedge. It doesn't work as reliably in the short term as, for example, U.S. Treasuries did last decade, when there was that very consistent negative correlation between stocks and bonds. But in general, what are you concerned about in this environment? You're concerned about uncertainty. You're concerned about equity market volatility on the back of that policy uncertainty. And you're also concerned about that long-term deficit and thinking about a store of value. In that context, gold works very well. And even though it's not a huge amount, we found it really has been a risk mitigant during the first half of the year.
And going forward, this is one thing that we're watching this week is the Senate coming back to Washington, D.C. and marking up the reconciliation bill. And a real question, especially as the likes of John Waldron of Goldman Sachs and Jamie Dimon of J.P. Morgan coming out and saying this is going to be a real problem if Washington, D.C. doesn't get the deficit under control. How much do you see this time as different? That this is a bond market and this is an investor base that is ready to protest in mass if this bill doesn't pass muster in terms of deficit reduction?
Well, I think this is the key question. Honestly, this is coming up in almost every client meeting I had. There is more focus on the deficit. I think there is more concern than I saw 5 or 10 years ago. Having said that, as we all know, the time is extremely difficult. When does this become a problem? Clearly, it's more acute than it was, let's say, 5 years ago in the sense that we're talking about bond market auctions, not just in the U.S., but also in Japan. That's something I don't remember as much in recent years. So how to think about it, again, there are parts of the bond market we really like. The short, the middle part of the curve, high quality spread has been a key part of the portfolio. But as we've spoken about in the past, we do remain a bit more cautious on the long end of the curve because you've got to ask yourself, are you being adequately compensated to take that long duration risk given the current U.S. fiscal situation?
Russ Kosterich of BlackRock, thank you so much for being with us. And it's something, Anne-Marie, that we keep hearing about, the idea that the 30-year Treasury is a risk asset at a time when it's very hard to calculate what the future might look like.
And that's why everyone asks whether or not the bond market is going to have a seat at the table when it comes to this vote for the one big, beautiful bill. We're talking about the Senate coming back. They have such a tight deadline, July 4th, to try to get this done. Every single senator on the Republican side is basically a king. Thune can lose 3 people because the vice president could be a tie-breaking vote. Well, there's a lot more than 3 people that have issues with this current reconciliation bill that was sent over by the lower chamber.
That's something that sounds like it's a recipe for a mess when everyone thinks that they're a king in Washington, D.C. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. China is accusing the U.S. of violating their recent trade deal and vows to take measures to defend its interests. The Chinese Ministry of Commerce is rebuking President Trump's claim on Friday that Beijing breached the consensus reached in Geneva last month. White House National Economic Council Director Kevin Hassett believes the 2 leaders could talk this week. Meanwhile, several people were injured in Boulder, Colorado in an attack on an event being held to support Israeli hostages. Police say the weapons appear to be bottles of flammable liquid, and a suspect is now in custody. Colorado Governor Jared Polis issued a statement condemning all hate-filled acts, while Boulder's police chief says it's too early to determine if the motive was terrorism. And former Fed Vice Chair Stanley Fischer has died. Fischer served as vice chairman of the Fed from 2014 to 2017, following 8 years as governor of the Bank of Israel. He mentored a generation of policymakers at MIT, including Ben Bernanke, Mario Draghi, and Kazuo Ueda. Fischer was 81. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, never going to default.
The United States of America is never going to default. That is never going to happen. That we are on the warning track and we will never hit the wall.
Terry Haynes of Vigia Policy joins us coming up next on a day we're taking back a little bit of the gains that we saw last month. This is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Coming into a new week, a new month with just a bit of losses after the biggest monthly gain in 18 months going back to 2023. This morning, we're taking back some of that across the board, led by some of the biggest gainers, the big tech names. NASDAQ down by almost 0.7%, S&P futures down by 0.5%. Yields are higher, dollar weaker. That is a continuation of what we have seen in the past, and this comes with, under surveillance this morning, never going to default.
the United States of America is never going to default. That is never going to happen. That we are on the warning track and we will never hit the wall. The deficit this year is going to be lower than the deficit last year, and in 2 years it will be lower again. We are going to bring the deficit down slowly. So the goal is to bring it down over the next 4 years, leave the country in great shape in 2028.
Here's the latest. Treasury Secretary Scott Bessent pushing back against concerns the U.S. will not meet its debt obligations. Republican leaders in Senate set to begin negotiating President Trump's tax bill, which includes an increase in the debt limit this week. Bloomberg's Tyler Kendall joins us now from Washington. Words you never really want to be saying. We're not going to default. How much of a concern is this on Washington, D.C. as the Senate heads back to deliberations?
Yeah, hey, Lisa, good morning. Well, it probably depends on who you ask and how motivated they are to really make this a focal point and a priority. As we know, one of the biggest issues of doing this as one big, beautiful bill is that there's other priorities on the table that Republicans are ultimately trying to get through. And in fact, Lisa, I actually posed one of your top questions to members of the House when they were negotiating this about whether or not they were looking at the bond market here. And you had members like Congressman Tim Burchett, a Republican from Tennessee, telling me, yes, he thinks, in fact, it's a canary in the coal mine. But then ultimately he ended up voting for the legislation as it stood. Now, the administration, for their end, really has been focusing more on what they say will ultimately grow the economy. I was at Treasury Secretary Scott Bessent's latest testimony on Capitol Hill last month, where he said that, yes, this bill will contribute to long-term debt in this country, but they're more focused on stabilizing the debt to GDP ratio, which he says will happen if the administration is able to implement what they think are pro-growth policies. But of course, a lot needs to really happen here at the end of the day. Treasury Secretary Bessent pointed to tariff as a revenue raiser as one example in some of his interviews over the weekend. But the question really becomes, is the Senate going to make some sort of meaningful changes to ultimately address this issue? And perhaps one of the biggest sticking points here is when it comes to lifting the debt ceiling. That could really be one of the areas that needs perhaps the most negotiation. Lisa, keep in mind the House plan would lift it by $4 trillion, but the Senate blueprint had originally called for lifting it by $5 trillion.
Tyler, I said earlier that everyone in the Senate is a king. The margins are just too slim. Who are you watching to make sure that this bill actually gets passed?
Anne-Marie, there are a few key senators that are emerging here. One is Rand Paul, a Republican from Kentucky. In fact, it seems President Trump is watching his vote as well. He singled him out in a post on Truth Social over the weekend. Lifting the debt ceiling is really one of the biggest issues here for Senator Paul, who has said he's not going to vote for any legislation that would do as such, and doubled down on his position in some interviews over the weekend, saying that at the moment the math just isn't adding up for him. He's sort of falling in line with some other members who are sort of pitching themselves as fiscal hawks, including Mike Lee of Utah, Ron Johnson of Wisconsin, and Rick Scott of Florida, who's really considered to be a key ally of President Trump's. And then on the other side of this, watch closely those more moderate senators who have said that they have some issues with those changes to Medicaid, such as Lisa Murkowski or Susan Collins. And then lastly, Anne-Marie, keep your eye on Josh Hawley of Missouri. He's someone who's really trying to thread the needle here when it comes to his broader support of the package, but has said that he does not like any changes to Medicaid, and he wants to see perhaps some bigger pullbacks when it comes to those IRA subsidies. Just another thing in this big, beautiful bill that we're closely watching.
Tyler Kendall, thank you so much. As always, we'll be catching up with you in just a little bit. Terry Haynes of Pangea Policy joins us now, and Anne-Marie nailed it. The line of the weekend really stood out to me from you, which is that Jamie Dimon's comments about the bond market potentially cracking somehow helps this administration. How does that make sense?
Well, thank you for that, first. And secondly, I follow that context because I read Bloomberg. So, and Bloomberg, I thought, reported very well on Dimon's comments. But Dimon's point was that if there's a crack in the bond market, firstly, it could be in months, it could be in 6 years, I think he said. It's because of essentially the decade plus of fiscal incontinence support. These are my words. Fiscal incontinence supported by accommodative monetary policy. So, you know, that's short of full-throated support for Trump and Bessent. But what it does say, and what I think the White House probably picks up on, is, you know, this is a mess we didn't create, and it takes us a while to unravel it. And you heard that in Bessent's comments loud and clear yesterday.
Well, Terry, what's the alternative? Americans' taxes go up next year?
Well, yeah, essentially, yeah. I mean, they're they're up against the wall in that sense. So they're not going to preside over anything that increases Americans' taxes, so they won't. And Besson's comment, of course, was essentially Rome wasn't built in a day, and neither was this situation, and we're going to decrease the deficit gradually over time. I think what Besson isn't saying, I don't think he's hiding it, but I think what he isn't saying is the bogey everybody's really looking at isn't debt or deficit, it's debt service, and debt service just became the largest category of spending last year for the first time, and they are focused on getting rid of that, largely because you can't be a great power for very long and have your wealth sucked into the black hole of debt service.
When you see the bond market pushing back, Terry, is it about the uncertainty regarding trade policy? I mean, just over the weekend, we also potentially are going to see 50% now on steel and aluminum, as well as all the tit for tat regarding China. Or is it about the spending plans and the one big beautiful bill?
I think it's a little bit of both, frankly. I mean, there's some restiveness generally. It's not just the United States, as you all know, about the spiraling levels of debt across the board, whether it be United States, whether it be the UK, European Union, whether it be China. And Besson's point about China is correct. It's not in great shape itself. So they're trying to do what they can to force a deal there.
Terry, when you talk to people in D.C., how concerned are they that the three-pillar stool is kind of having some issues, is getting a little bit wobbly right now at the increase in tensions between U.S. and China, as well as this question about how quickly they can get through this bill?
It is much clearer in Washington than it is to markets, for whatever reason, that so much of this has to do with geopolitics. My top theme, as you all know, is geopolitics is essentially, for the United States, is essentially driving economic policy. They see it very much that way, too. That's very transparent. Concerns alone about the lack of defense industrial base have been mounting for years. And the way to look at the manufacturing push, the way to look at what happened with U.S. Steel and Nippon Steel is an attempt to address that, frankly. And it's the major reason why Trump and Republicans are going to continue along to try to put the United States economy in the best growth position to counter China and be much more attractive partners to countries from the UK to Australia to India and everywhere in between.
Yeah, but is it working, Terry? I mean, this is what I'm asking, given the fact that China and the U.S. seem to be at an impasse. There's a question about how quickly some of these other deals can get through, given the fact that we keep hearing deals are going to be announced any day now.
I'll take the glass half full on that. Again, my bogey on this is probably around July 4th, partially because that's what Trump wants for the tax bill, partially because a lot of the other trade-related things, major trade deals and the like, as well as decisions on reciprocal tariffs, are all scheduled to hit at that time. So what they're hoping is that they combine a series of events that provide a much more positive market direction and a much more positive look for the United States economy.
Terry Haynes of Pangea Policy, thank you so much for being with us this morning, and good luck this week. I do wonder, Anne-Marie, how close some of these deals are. We have heard Kevin Hassett talk about there are a couple of deals that it could be announced any day now. We've talked about Japan. We know that the UK was announced, but there's still some details that are trying to get worked through.
Yeah, and the UK now has questions, talking to the Financial Times over the weekend about what the 50% new aluminum and steel tariff level might mean for the deal that just a few weeks ago they already inked.
And it does look like potentially Canada and Europe are the ones that end up with the biggest part of that. Coming up, we're going to discuss this a bit more. Former Trump trade official Kate Kalukowicz, as U.S.-China trade tensions ramp up yet again. From New York, this is Bloomberg.
The President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China in 2023. It's something like $40 billion. And whatever the tariff rate ends up being on China, it's going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business. The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Coming into a Monday with a bit of a softer tone after the biggest May performance for the S&P 500 going back to 1990. The biggest return, more than 6% going back 18 months since 2023. Today we are softening a bit, led by some of the biggest winners are becoming the biggest losers. NASDAQ down about 0.7%. Take a look at what's going on in the currency space. We have seen a consistent dollar weakening trend, and that continues this morning with now the euro at the strongest versus the dollar in more than a month, going back to late April, and it goes at a time when Morgan Stanley is talking about the dollar poised to weaken an additional potentially 9% over the next year, with many other banks piling on and saying the same. 3 hours away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. We start with steel stocks soaring after President Trump said he'll double tariffs on steel imports from 25 to 50%. So the big winners are American steel companies like Cleveland-Cliffs. Those shares are up more than 30%, as well as Steel Dynamics and Nucor. And just to give you an idea of where we stand, the U.S. still imports 17% of its steel. So yes, this move will help domestic producers, but it's a headache for those in the auto and housing sectors, which will see material costs rise as a result of these staggering 50% tariffs. And speaking of autos, we are seeing shares of Stellantis falling nearly 3% now, some of that having to do with the steel tariff impact, since it does have factories here in the U.S. But also, we got numbers out of France for new car registrations showing overall weakness in the auto sector there, and the declines were led by Stellantis. And last up, we end on some M&A action. We are seeing Blueprint Medicines up to nearly 27% now after Sanofi agreed to buy the U.S. biotech for $129 a share in cash. That represents a 27% premium to Blueprint's closing price on Friday, and that is a hefty price in a market where pharma M&A has been cautious. We haven't seen big deals like this one out of pharma this year. Lisa?
Thank you so much, Yahaira. And it seems like a bit of a merger Monday coming back, which is actually notable after the absence of any such deals earlier this year.
Yeah, potentially they're feeling like it's a green light to actually do something, maybe a little bit more of reading the tea leaves in Washington, D.C. and the push for deregulation, easier business environment out of the Trump administration.
So how do you read this tea leaf? On our radar this morning, China accusing the U.S. of severely violating their 90-day trade truce, saying the White House is imposing new discriminatory restrictions with its AI chip export guidelines and design software sale curbs. This just puts another potential wrench in the works when it comes to this ongoing discussion.
Right, and it's a flare-up, new war of words between these two after we saw that détente. But that détente was just a month ago. The question I really have going into this week is, now that we have this war of words between Friday and today, between Washington and Beijing, what does this mean for the call that we were expecting between Xi Jinping and Donald Trump. And we're expecting that call because the White House told us they were expecting a call this week. And you have to just wonder, does this just diminish that? And that means that potentially this is going to be further pushed. And this relationship, which seemed to be moving in the right direction in terms of dialogue, is now put on ice.
We're going to be talking more about this with Kate Kalukowicz, which I think is going to be a really important conversation, in part also to understand what are the ultimate goals, because I feel like that's part of what's getting lost in this conversation. What does this new trade relationship even look like? We'll get to that in 1 second. In the meantime, the European Union saying it's prepared to impose countermeasures after President Trump threatened to double tariffs on steel and aluminum to 50%. Existing and new EU levy measures are set to take effect on July 14th. It feels like we're moving perhaps a bit further away from some sort of détente here as well.
So the EU had paused those countermeasures, but they have a list somewhere. So when they say they're going to come out and respond to this 50% new tariff, potentially a higher threshold on steel and aluminum, what does that mean when it comes to the EU countermeasures? They have that list. Are they just going to ratchet up their tariff level as well? We don't know. But I would imagine a lot of this right now is also just tension brewing, why they tried to work out a trade agreement. But can they get this done in time? Because they are one of a handful of countries that are also trying to get to the finish line with this administration.
But aren't they actually cracking down on China too right now?
They are. They are. They're looking at the procurements when it comes to China, and they are talking a little bit tougher. Potentially, that is something the United States wants to see out of the European Union before they ink a deal.
The other aspect that people are keeping close eyes on is Russia and Ukraine set to resume peace talks in Turkey later today. The talks come after Ukraine staged one of its boldest aerial attacks on Russia, and Moscow retaliated with a drone and missile attack against Kyiv that killed at least 12 people. Ukraine's attack on Russia targeted planes that were capable of delivering nuclear loads as well as other potential equipment. What do we know about how much this was an escalation?
Long-term planning on Ukraine's part to carry this out. Zelensky said 34% of Russia's strategic bombers were hit. At the same time, then, Moscow did respond, and you saw a barrage of missiles down on Kyiv. And this sets the tone going into today's meeting. Samuel Sharap, who I follow, who at RAND, talked about the fact that when you read headlines proclaiming today's talks a failure, bear in mind the expectations of anything resembling a breakthrough at this stage in the process do not reflect the realities of the war. This is going to be a long, hard slog, and I think those realities were on full display the past 24 hours.
We'll be keeping track of that throughout the day. Turning back to trade, China hitting back at the Trump administration, accusing the U.S. of violating its trade truce. Former Trump trade official Kate Kalukowicz joins us now. Kate, thank you so much for being with us. What's your take on the ratcheting up in tensions that we saw between the officials in China and the U.S. over the past 4 or 5 days?
It has been a whirlwind, I think, in the U.S.-China space. Of course, we saw huge tariffs. We saw those tariffs come down without much else agreed between the two parties, and now this war of words. I think it lends itself to the fact that some of the very baseline issues between the two nations remain very much in place, even though domestic pressure forced both sides to bring those tariffs down. So we're very much in the same space without the tariff pressure, I think.
Kate, is there really going to be an agreement if there isn't some understanding between the two countries on the AI sector and advanced semiconductors?
Well, you know, I suppose it depends on what China is willing to accept here, because I think that it's very clear from the United States perspective that these types of export restrictions on high-tech goods are here to stay. In the big strategic economic competition with China, the focus from both sides, frankly, in D.C., has been to restrict access of these technologies. So unless China is willing to accept that, I think we're not going to see an agreement. They're going to have to decide, I think, whether this is a status quo that they can move forward with.
Is there a chance that the Trump administration gives in more and allows them some more access to this sector?
Well, you know, President Trump, of course, has sent some mixed messages around what he expects and hopes from China. After the tariff détente, the president announced his long-term goal is to do business with China, which, you know, undermines a bit this notion that we could really sever our economies. So I wouldn't say never. The president certainly has shown, you know, willingness to walk back some of his strong rhetoric, but this will be difficult because, you know, in a bipartisan way, Congress has been quite firm on this point.
The rhetoric we've seen, the war of words back and forth over the weekend from Friday to today, could that derail a potential talk that Kevin Hassett said we should expect this week between the two leaders?
I suppose it could, although the signals I see on the U.S. side, at least, are very strong language from the president, softer language, of course, from his cabinet officials. We saw Ambassador Greer, Secretary Bessent try to walk back a bit the very strong tone to say things aren't going great, but we're hoping the leaders will speak. So the U.S. at least is sending a very strong signal that it would like to see a leader-level discussion.
Do we have a sense, Kate, of what the ultimate goal is? It feels like that's getting lost in all of this. Is the idea to decouple with respect to tech between the U.S. and China at a time where NVIDIA is saying that that's not the answer? Is it to just isolate China with the allies that we have, albeit in a somewhat messy way? We don't have a real sense of that through all of this, do you?
Well, I wish I could help come up with a stronger, clear plan here. The reality is the president has many goals when it comes to economic relationships with the rest of the world. And at times these do appear somewhat to conflict with one another. As I said, I do think his long-term goal here is to reset the relationship with China, but to continue to have an economic relationship with China. Regrettably, I think some of these other discussions, whether it's with the Europeans, India, others, these steel and aluminum tariff announcements, cloud the framework of where we're going to go with China. So I'd say we're not quite there yet. I don't know that the president has been as specific as he needs to be with the Chinese as to where he hopes to go. And so we're going to need to have a little bit more discussion before we can see something emerging.
We heard over the weekend from a number of different advisors to President Trump that July 9th is the deadline and it will not be extended past that in terms of the reciprocal tariffs. Do you believe that?
Well, I think the president is always flexible, and I think if we need to go beyond July 9th, we'll find a way to go beyond July 9th. Of course, the president is a bit on his heels given the court decision last week, but I think it means that he's going to show signals that he can move tariffs forward in other manners, as we've seen. We saw the announcement on steel and aluminum. He has quite a few other tools in his toolbox to bring to the ready. So I think other nations really ought to continue negotiating with the United States and keep this date in mind. It benefits them as well to negotiate some deals before the president starts to use these other tariffs. But if we need to extend, I think the president and certainly Secretary Bessent has indicated if we need more time, we'll take more time.
Just quickly, when you talk to your clients, what are the risk dates, the risk events that you have that you flag to them saying this actually you need to keep your eye out for?
Well, when I talk to my clients, I really say, predicting is too late in the game. We need to anticipate big outcomes as opposed to the actual when and the dates into when they might occur, because we know the president wants to move on large-scale sectoral tariffs. Beyond IEEPA, beyond China, we are anticipating several big decisions this summer when it comes to semiconductor tariffs, pharmaceutical tariffs, copper, critical minerals, and a range of other 232 tariffs. We have impending review of the U.S.-Mexico-Canada agreement. So when I speak to my clients, we're working to prepare for all of these eventualities to ensure that they're well positioned even before a date is announced.
Kate Kalukowicz, former Trump trade official, thank you so much for being with us. And Anne-Marie, I guess that's kind of what we saw with the 50% steel tariffs. That wasn't on my bingo card. Was that something that was on your radar?
Well, potentially this was the president delivering to a constituency that he said he was going to block this Nippon Steel, U.S. Steel deal, and said allowing it to go through. We're still waiting on a lot of these details, but at the same time saying, but I'm going to make it harder for all of that steel that's coming into the United States to come in. They have no choice now but to buy American.
More on that in just a bit. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. OPEC Plus has agreed to increase oil output for the third month in a row, despite reservations from Russia. Oil-producing nations say they're adding 411,000 barrels a day to the market in July, matching increases scheduled for May and June. The supply hike is seen as a move by Saudi Arabia to punish overproducing members, recoup market share, and satisfy President Trump's desire for cheaper oil. Meanwhile, dozens of people have been killed near two aid distribution stations in the Gaza Strip. Medics and witnesses say Israeli forces fired on Palestinians gathering in southern Rafah and the Netzarim corridor. Israel's military denies those claims based on what it calls its initial inquiry. Meanwhile, a U.S. proposal for a ceasefire that would increase aid to Gaza is in limbo after Washington rejected a Hamas counteroffer. And billionaire Elon Musk said he is not using the ketamine, disputing a report by the New York Times. Musk wrote on X, "I tried prescription ketamine a few years ago and said so on X, so this is not even news." The Times reported on Friday that Musk had used drugs more heavily than previously known during Trump's presidential campaign, and that he took ketamine often and also used ecstasy and psychedelic mushrooms on occasion. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, doubting the dollar.
If I'm a long-term investor, I may have my doubts about the dollar, but I want to wait for those, for those doubts to be confirmed. You don't want to be, upstream without a paddle.
That conversation coming up next with Matthew Hornbach of Morgan Stanley. Right now, we are seeing a weaker dollar with the euro at one of the strongest levels that we've seen it going back more than a month. This is Bloomberg Surveillance.
In case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%. And I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running at like 20, 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back to a new trading week. Right now we're looking at a bit of softness in the heels of increased trade tensions. What a surprise after a weekend where there are some headlines. And it is causing a bit of a retracement after last month's blowout returns. We are seeing it led by the tech sector. NASDAQ down 0.6%, S&P lower by 0.5%. You can see yields higher. So this move that we've seen, this sort of negative, this unfortunate positive correlation between bonds and stocks where yields go higher. Bonds sell off in tandem with stocks across the board, although led by the long end, 30-year yields 4.96%. And what you can see in the currency space is ongoing dollar weakness. This question of how much are we seeing a flight from U.S. assets, in particular the dollar, with the euro at one of its highest levels, strongest levels versus the dollar going back to late April. Under surveillance this morning, doubting the dollar.
It's not a story of the U.S. getting worse than everyone, but it's a story where the U.S. falls back into the pack. If I'm a long-term investor, I may have my doubts about the dollar, but I want to wait for those, for those doubts to be confirmed. You don't want to be, upstream without a paddle.
Here's the latest. Dollar sell-off accelerating as trade and geopolitical tensions take center stage yet again. Matt Hornbach and the team at Morgan Stanley looking for the greenback to hit COVID-era lows within the next year, predicting the U.S. dollar index will fall 9% even after the big decline so far this year. Matt joins us now. Matt, it is wonderful to see you. It's been way too long.
Yeah,
Welcome.
Thanks for having me on the show.
Yeah, you guys wrote a really interesting note over the weekend talking about your full year review. The dollar is going to weaken even though you still see potential upside for other U.S. assets. Explain.
Well, investors in the United States, Lisa, have a tremendous home bias, and we don't think that is changing anytime soon. What we're really seeing is investors outside of the United States take a second look at their exposures to the U.S., both in terms of their asset holdings, but also in terms of the currency exposure that they have related to those asset holdings. So one of the things that we're expecting are investors outside of the U.S. to increase their currency hedge ratios. And that's not something that requires them to sell U.S. assets. They don't need to sell the money that they have in the S&P 500, but maybe they take up their currency hedge ratios, and that is one of the factors that we think will be putting downward pressure on the dollar over the next 12 months.
It's one thing if investors don't want to go into dollar-denominated assets. It's another thing, and I'm talking about international investors, it's another thing if they actually are trying to just hedge against the dollar. It's two different things, and there's this question about the bond market and whether these international investors are wary of parking their money there. How do you see a scenario where yields could go down? You could see a bid into the bond market even at a time of international flight from the dollar.
Yeah, well, this is exactly why we think that in this move to lower yields that we're forecasting, you have a very large curve steepening. In fact, it takes the shape of the curve to levels that existed the last time the dollar hit those lows that you mentioned earlier. So we are expecting the Fed to cut rates, not this year, but next year. We've got the Fed cutting 175 basis points next year. That is way more than you see priced into the bond market today. And that's one of the main factors that drives yields lower. But that move is primarily driven in the long end, the short end of the curve. So you get this very large yield curve steepening, and that's going to bring us back to levels that existed before the GFC, we think.
When it comes to the dollar, is the direction of travel highly dependent on trade policy?
It is dependent on trade policy, no doubt. If the reciprocal tariffs were to go back into effect, that's not the baseline view of our public policy strategists, but if we do see something like that, then I think we would have to adjust lower our dollar forecasts. And they're already well below current levels. They're well below consensus forecasts. So we would probably have to change them again if the reciprocal tariffs went back into effect. That's not our baseline, but certainly somewhere in the realm of possibility.
So what are you recommending to go long on if it's not the dollar?
Well, the currencies that we are most interested in buying would be the euro and the yen. Effectively, the DXY index, if you wanted to summarize it, would be the index that we would be trading the dollar short from. But those would be primarily the two currencies that we like the most.
As I was reading your note over the weekend, I was struggling to understand this idea of a much steeper curve and yet a growth environment that would be conducive for risk assets. I'm thinking about the housing market. I'm thinking about businesses borrowing long in order to make capital expenditures and things of that nature. How do you have that type of scenario when you have a yield curve that looks something like how it did before the great financial crisis?
Yeah, well, we do have growth slowing. That's important. When you talk to Seth Carpenter or Michael Gapin, what they're going to tell you is growth slows, but it doesn't dip into recessionary territory. And it's that type of slower growth, lower interest rate environment that ultimately will sow the seeds for a rebound in economic activity beyond our forecast horizon. Financial markets are forward-looking. So by the time we get to the end of our forecast horizon, right, in the end of 2026, you should have some asset prices having a bit more of an optimistic view on what comes thereafter. But that's not something that we're forecasting in the next 6 to 12 months.
How do you price in the deficit, which seems to be the boogeyman for everyone from Jamie Dimon to John Waldron of Goldman Sachs? You have a lot of officials that are coming out and saying, this is going to be the U.S.'s Liz Truss moment. How do you shrug that off and say this is something much more pedestrian and normal?
Well, look, I've been listening to investors ask me about these big deficits for 25 years. I've been, talking about bond vigilantes for 25 years. I don't know where they are. The bond vigilantes show up every so often, and then they go hibernate for the next 10 years. So, I guess I'm growing a little tired of it, to be honest. But it is a topic that is worth talking about every so often. And I think the type of deficit expansion that we're forecasting is not a usual type of deficit expansion. By and large, we are extending tax rates that are already in place. This might have a deficit impact depending on exactly what baseline you're operating from. But in terms of the economic impact, we just don't see it. And so you have this kind of very mixed emotion in the bond market. Typically, you get a big deficit, you get a big expansion in the economy, bond yields move higher. That is, I think, clear cut. This is not that type of deficit expansion. So the bond market has mixed emotions. In fact, some of the spending cuts could weigh on growth. It's not a usual deficit expansion.
Is that mostly because at the crux of this bill is just extension of current policy? And if we don't get this bill, this means American tax rates are going up.
That's right. That's right. I think our bond yield forecast will almost certainly be lower if we didn't have an extension of these current tax rates. So the extension of the tax rates doesn't do much for the economy, but it does expand the deficit. And so we should see higher supply in the Treasury market, but most investors that we've been talking to for the better part of a year now have already expected that. So I don't think it's going to have a big impact on the market itself.
Just to sum up quickly, it's economic growth, it's not supply. Is that what you're saying?
It's supply, it's not economic growth. So just to twist it. But yes, effectively, we do see more supply, but we just don't see a big economic effect.
Matthew Hornbach of Morgan Stanley, thank you so much. It seems like in terms of what the drivers are for the bond market, it's going to be the economic growth or the lack thereof, and not necessarily just how many bonds are being sold.
A little refreshing in the sense that we have the story out this morning that there's a buyer strike on the long end from Double Line Capital and other investment firms avoiding or shorting the 30-year U.S. Treasury. And to Matt's point, we've been hearing Jamie Dimon talk about drunken sailors in Washington, D.C., the way they spend for years. Not sure why it's exactly this moment.
Well, to be fair, it does seem like people are expecting that steepener, this idea of yield curves going to a very different type of level. And it does seem like people are getting a little queasy of 30-year yields. Whether that continues, yippee, a lot of yips out there. We'll discuss this coming up next with Sarah Hunt of Alpine Saxon Woods, Bloomberg's Tyler Kendall, Brandon Ferris of the Steel Manufacturers Association, and Aditya Bahave of Bank of America as we parse through all of the economic data, the trade tensions, and potentially what's going on with the naysayers out there of the deficit. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Uncertainty is the theme for the market, and it starts to become a headwind for equities here.
The market, has probably some near-term upside, but there's a trading range here.
Yeah, I'm not a buyer of the end of U.S. exceptionalism.
It's back to the U.S. It's back to the U.S. tech.
There is still a narrow path here towards, a better outcome than I think markets are expecting.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance with another week of trade whiplash. Yes, we have economic data with a countdown to non-farm payrolls, but everything that happens before that may be even more important with rising trade tensions with China and the Senate, Anne-Marie, coming back to budget negotiations.
I think all of this really centers on whether or not we get another rapprochement détente between Washington and Beijing, and potentially the breakthrough could be this call that Kevin Hassett told us yesterday he was expecting this week. And then what do we get this morning? More tit-for-tat war of words between Washington and Beijing. The Chinese Commerce Ministry saying Beijing, quote, firmly rejects these unjustified accusations from the U.S. on Friday. This hour, the president was truthing that China has actually gone away from what they agreed upon in Geneva when it comes to these raw materials.
Is that what it is, truthing? I think that's what we have to say now, that he was truthing out there this morning. I am wondering how much there's this battle between the ongoing tit-for-tat that we see between the U.S. and trade partners, and just the nuts and bolts of what drove the rally of the last month, which is earnings have been amazing. And big tech, Danny Berger, has been very much back in focus.
It's been back in focus so much that if you took that out of the picture, the S&P would not be up for the year. It is back up for the year, but it's still not outperforming internationally. It does seem to be that everyone's gorging on trades with this idea that tariffs are negotiations, not outcomes. And that narrative works until it doesn't work. For now, it's working, but does that change at some point?
Meanwhile, people are trying to figure out what's the next catalyst. We did have this blowout earnings season, as Julian Emmanuel was talking about. We have the jobs numbers on Friday. A lot of people talking about this as also a key catalyst. But Peter Scheer put some dampening spirit on that over the weekend, saying a lot of this data is becoming increasingly unreliable because these survey response rates are going down. We don't know what to do with soft data. And frankly, people don't understand what's backward looking, what's forward looking, what's sideways looking, and what's just simply, Danny, irrelevant.
Or if you're Chris Waller, who gave a speech very recently, said even if the survey data is right and consumers are expecting more inflation, the labor market's so tight that they're not going to be able to demand more wages. So in that way, you can pour more cold water over it, saying, yes, consumers expect more inflation, but that's not how it's going to play out.
Meanwhile, in Washington, D.C., the budget very much in focus, and that's something that a lot of people are wondering, do we get the bond vigilantes? I mean, Matt Hornbach just also pouring some cold water over it, saying, I'm sick of it. Stop coming to me with the bond vigilantes. They're not coming. We haven't seen them. They stay for about a half a minute, and then they leave. But there is a feeling that maybe, Anne-Marie, this time is different.
Well, they've been complaining for decades, and that's Matt's point. I think also the crux of Matt's argument is when you look at this bill, the nuts and bolts of it are extension of current policy. And if you don't have that, what kind of trigger to not having growth could there be if you have American tax rates going higher, especially if people are concerned with inflation? So is this really going to be stimulative, or is it extension of current policy and a few sweeteners that the president has promised on the campaign trail?
I also think for the markets, the remarkable thing is the degree to which we keep swinging back and forth about what we care about. One day we care about trade, one day we care about the fiscal budget. I just don't know how you operate in that kind of environment, how you have any conviction in this type of environment where the narrative and what's shifting things changes from day to day.
What you do get is a lot of notes that say range bound. We're going to be trading within a range, and that's what you hear again and again. What you see in markets is a bit of softness. After the best monthly performance going back 18 months, you can see led by big tech, which have been some of the biggest winners. You can see across the board, S&P futures down 0.4%, and NASDAQ down 0.6%. The Russell actually doing better, ironically enough. What you can see in the yield space is not what you want, which is positive correlation in all the wrong ways. Yields higher, bonds lower, as people look to Washington, D.C. for the deficit. A question of who's going to buy that 30-year, maybe not PIMCO, maybe not Double Line, maybe not JP Morgan Asset Management right now, touching up against that 5% level, up about 4 basis points. Meanwhile, in the currency space, this has been the theme and something that a lot of people are taking notice of, dollar weakness across the board. Dollar, the weakest, one of the weakest levels going back more than a month versus the euro, as people question whether this still is the type of haven spot, and also whether it just simply has gotten overvalued over the past couple of years. Coming up over the next hour, Sarah Hunt of Alpine Saxon Woods with their stocks coming off their best May since 1990. Brandon Ferris of the Steel Manufacturers Association with President Trump set to hike steel and aluminum tariffs, and Aditya Bahave of Bank of America as the Fed games out its rate cut strategy amid trade uncertainty. We begin this hour with stocks lower. U.S.-China trade tensions back on the table. Sarah Hunt of Alpine Saxon Woods writing, where do we go from here is always a tough question, but under current circumstances, to echo what Danny was just saying, it is difficult to have conviction about the economic environment. The understatement of the year. Sarah joins us now. Sarah, thank you so much.
Good morning.
What is your compass at a time when, as Danny and Anne-Marie were talking about, there's so many different things that you have to have kind of a head on a swivel and pay attention to one thing at a time?
Well, I think, certainly for the economic data, there's a lot of questions about whether or not the trade tensions and the tariffs have pulled forward a lot of activity. So it's hard to understand whether or not some of the good current economic data is because people have rushed out to buy things or not. I think you have to keep looking at earnings. And right now, to your point earlier, that's been a pretty good situation. The technology stocks have really continued to carry the day, and they have not been pessimistic about CapEx and spend. And I think that in all the other noise that we can see, company earnings are going to be important because that's what underpins valuation. So to the extent that that's something to look for, you have to be able to see that continuing to look good. And right now, that still looks pretty good.
It is an incredible amount that the hyperscalers, the big tech companies, talked about spending. Their capital expenditures numbers were still huge. But if you remove that from American stocks, what are you left with, Sarah? Are you still as enthusiastic?
I think if you remove that, you have a problem. And that's one of the reasons that equity markets were able to pick that story back up and put it down and pick it up. To your point about switching narratives and what they care about. That AI story was a big piece of last year, and then there was a lot of questions about whether or not people didn't need so many data centers, didn't need this, didn't need that, what was everybody doing? And now the fact that that's back at the fore and people are willing to spend that money, I think is critical, because beyond that, there are good things underlying in some other areas, but there are some places where there's a lot of uncertainty, which is why people are pulling guidance.
So is there the glass half empty side of this and the glass half full side? The glass half empty is you don't have anything. What do you have? The glass half full side is, yeah, look how well they're doing. So imagine how well the others can do. We better get in over there. Which side do you land on?
You know, that's part of the problem, because it keeps changing what's going to happen, and the market reacts so fast. You saw how fast it reacted to that change in tariffs on last week, and after this fantastic May, because everything was going to be fine, then all of a sudden maybe it's not going to be fine anymore. Those narratives keep flipping on a dime, and that's why you have to keep looking for those underlying, boring-sounding things. Do you have cash flow? What's your balance sheet look like? All that sort of stuff, because in an uncertain environment, that's what you have to do with. And that word has become so ubiquitous that it's almost impossible not to use it, but there you are. I mean, that's what we've been living with.
I gotta say, it does feel like we're starting to get to this environment where there is some headline fatigue, where a headline comes out about some new tariff and we say, okay, Trump's probably gonna back out, and we don't trade massively off of it. When it comes to those types of headlines, how do you distinguish what is signal and what's noise?
It's very difficult, because part of the strategy is continuing to make a lot of noise, right? So it's very difficult to underpin and know what's happening, because none of us know unless we have a window into the thought process of what's going on. So you don't know, and you have to just sort of look at a probability scenario and go, what are the odds that it's going to be so punishing that we're going to continue on that path? And then you have to say, I don't know that we're going to go down that road, even though right now it looks pretty grim. And I think that that's what April was all about, because April was building in all of the, oh my God, all the things are going to happen and they're all going to be bad. And then May was reversing that. And now we're back in the risk-reward scenario where you kind of look at it and you go, okay, what's going to drive things higher? And then it's got to be the environment and earnings.
But on average, even though potentially we've seen the worst of the tariffs be lifted, there's still tariffs, minimum 10% across the board.
There are still tariffs, but you're still seeing margins not be affected too terribly yet. Margins are going to be a big part of that, because even if you can grow your revenue, if your margins are collapsing because of higher costs or because of the tariff situation, that's going to be an issue for earnings. It all comes back to what is the outlook from an earnings perspective, because from the equity side of the market, that's what they care about, is that earnings growth. And if you don't get that, that's where you have trouble.
I'd love to get your thoughts on this idea, though, that even though we have seen these AI companies and tech companies do so well, Ty Kim, who wrote this book on NVIDIA, had this stat after they reported earnings saying NVIDIA would likely have been a $4 trillion company right now if Trump didn't ban the H20 chip. So while they're still doing well, how much capital is still left on the table for them just because they're being isolated out of China?
I think that is one of those difficult questions, because you can see both sides of the argument, right? You can also see why you would want to have some restrictions on there, and you can see why that's hampering. But to say NVIDIA is being hampered is a bit of a stretch at this particular point, because they still own most of that very high-end chip market at the minute. Doesn't mean they will forever, but they certainly do now. So I think that, yes, there are some issues there, but I think from a security and everything else standpoint, you can see why you would want to have some limitations.
So it's led to a lot of chop, all of this. But Lisa was pointing out the one area that doesn't seem like it's had a lot of chop is the dollar, just this consistent weakness. And usually that's something of a ballast in a portfolio, something of a stabilizer. Are we in a moment of a structural shift where just your overall portfolio composition, the thought of what that looks like, needs to change?
Well, I mean, so the dollar was trading quite strongly prior to all of this. So we're down, and we're down to levels that we've seen in the last several years, but you go back to 2021, the dollar was even lower. So if you look at that from a longer term perspective and say, there's also a switch in the currency markets about what they care about, right? It's what's wrong with the U.S. versus everything else is doing better, but can Europe really get to the point where they make some big financial commitments and start spending? And if they don't, what happens to the euro after that, right? So there is a trade-off in currencies, and it's usually not because someone's doing particularly well, it's because someone's doing particularly poorly, and everybody looks at that and says, we'll go someplace else. And I think right now the focus has been on the dollar, and it was maybe coming into that a little too strong to start with. So we'll see where we go from here. But it is, I mean, we have come down quite considerably.
Sarah Hunt of Alpine Saxon Woods will be sticking with us as we try to make sense of what seems to be very difficult to make sense of. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Iran has rejected a UN nuclear watchdog report accusing it of nuclear violations, claiming the agency is motivated by politics. The report says Iran has expanded its stockpile of near weapons-grade uranium and failed to report nuclear material and activities at 3 locations. Iran says the findings are based on fabricated data and repeated that it's not seeking atomic weapons. Meanwhile, Karol Nawrocki has won Poland's presidential election. The nationalist candidate backed by President Trump is a conservative historian and former boxer with no previous political experience. He is expected to lead the country in a more populist path. And as Lisa said, it's M&A Monday. Sanofi has agreed to buy Blueprint Medicines for at least $9.1 billion, bringing the pharmaceutical